He blinked. He blinked. Chris Beecham. The bond market beat Trump, and we hopefully all benefited from it.
Bill Clinton's strategist, James Carville, once said, I want to come back as the bond market because you can intimidate anybody.
And oh boy,
Perfect.
it really did.
It really did.
Yeah.
We know where that line in the sand is, where that Trump put is. It's not in stocks.
That's it.
It's in bonds.
That's it. Good morning. Welcome to the show, everybody. It is Thursday, the 10th of April. You are watching Trade Live with IG. A very good morning to you all. I see Boise in the chat. Waka Waka, Supersonic, R6N, and Maturin. Away from the numbers, Neil, thank you for that call. Supersonic, Carlo, Andrew. We got a full chat this morning. It's almost as if the bull market's back.
Almost. Almost as if.
Let's have a quick look at see what is coming up on today's show. On Relief Rally Day, we have got oh dear, what is happening here, guys? Right, we've got Chris Beecham and myself through to about 8:30. Then Martin Harris is going to join us. Jamie Goldstein is our guest of the day, the founder of Z Hotels. Jamie has been in before. He's an IG client. He loves those FTSE stocks. So I thought I'd bring Jamie in to discuss what we've seen this morning so far, and also having a look at the All Sessions Open. And then 9:25. Guys, what are you doing? Trader Tools with Tom Wilson home. He's back. That's right. I aggravated him on Tuesday, pressed a few of his buttons, but he has agreed to come back.
I was watching that. It was good fun.
Yeah, makes it more exciting.
Poking the bear.
Yeah, he wasn't happy. 9:40. Aaron Bright, our strong economic, Mr. Aaron Bright with his. Well, you guys do a great podcast together.
Yeah, he's good fun, Aaron. He knows what he's talking about.
He definitely does. Yeah. So let's dive into it. Let's go to overnight action and talk what on earth happened yesterday. Chris Beecham, where were you when one of the biggest announcements in this history of stocks happened?
Standing in my kitchen making dinner. I was
as well.
I was making dinner and I was just about to, and I looked, I thought, why is the Nasdaq up 7% at that point? And it was a kind of, I think I better turn the laptop on and see what it's doing.
So I get this delivery kind of fresh pasta thing. And I just...
that's the most unsurprising thing you've said all day, really. Of course
I feel like I'm still cooking for myself, but it's not delivery.
Hand-rolled in the morning for you? Is that what it is?
Most likely.
Heaven's sake, you're such a metro liberal.
But I had put the pasta on, right, and then was waiting for the sauce. And then my phone just went ping. So I had an alert on my phone. Every 50 basis points, this S&P goes up. And every 30 basis points, the US 10-year Treasury goes up. It pings, and it just went ping, ping, ping. And I went, shit, and ran to the laptop, got it on. CNBC were so slow to confirm it because, of course, the mess that they had on Monday with Walter Bloomberg.
Once bitten, twice shy. Yeah, exactly.
But it was there on X. On X, they had confirmed 90-day delay from Trump. And wow, oh wow, did the market
what a moment.
Enjoy it.
What a crazy moment to see that. They're calling it Blink Wednesday.
Blink Wednesday is...
Wednesday. Because they it's going to be Black Monday, the market's in a slump. Kramer said now's the time to panic.
Yeah.
Whatever it was.
He said 4,000 S&P.
Yeah, he was... But then you had Wednesday. And it just... And what... I run out of words.
Run us through your overall take. Because, of course, Chris has got a tariff special tonight.
Yes, the webinar tonight at 7:30. So it will still happen. I've not written the slide. Yeah, I've not written the slide yet. So I was pleased because I don't write them well in advance anyway because I'm that kind of person.
Oh, thank goodness. Well, I mean, Goldman's went out with a call that we're going into a recession at 4 o'clock yesterday.
4 o'clock, yeah, and then 90 minutes later, about 90 minutes or so, wasn't it? An hour and a half.
Yeah, same.
And then said actually,
it's all okay.
Yeah, it's all fine. It's fine. Sorry about that.
Run us through from a chief market strategist point of view the kind of overall picture.
Well, I think what it means is that it? Are we finished with the sell-off? I know a lot of people are looking at the chat, people saying no, it's going to go back down again. I think what happens now, because okay, the tariffs have been paused for 90 days on everybody except China.
Yeah.
Obviously, China's gone up to 125%. So you are now essentially having the two largest nations in the world, the most important trading nations, essentially in trade embargo. They're trying not to trade with each other. So there's still the potential for major damage. Even at 10% on everybody else, tariffs are the highest level they've been in the US since the Great Depression. So they're still at a very high level relative to where we were.
Yeah.
So this is a kind of, the trade war is still on in a sense. It's just not going to be as bad for everybody else as we thought if this 90-day pause turns into, okay, we'll stay at 10% or they'll come down in due course. So there's still the potential for major economic damage, I think. Maybe just not as quickly or as dramatically.
And look, Poppy has nailed it there, right? It's great to have another female on the chat, isn't it, R6 Senna? It takes the left tail out of outcomes. What do we mean by that? The real risk when we were seeing bond market stress, the real distress in that lending market, in the debt market, the tail risk there means that you had a financial crisis, you had S&P 4000, you had a deep recession or a depression. Those are now gone. So you can take out any, okay, there's a 10% chance that would happen, but you have to put into calculation that your 4,000 S&P is a 10% chance. Therefore, it affects your probability outcomes. That left tail's gone. That's why the rally holds. All right, it might not hold at 54.80. We see it drop back to 5,400.
Yeah.
But the first thing I did was sell 5,100 puts to take advantage of the vol compression.
Because I think this is the thing, because there's still this potential hit to trade. The key thing about this is that it will take weeks and months for this to really be felt. So you could have, and I was looking back at 08, you had sort of periods where 2 or 3 months the market would rally, as you remember, and everyone thinks it's fixed, and then it's sold off again. So in bear markets, you can see extended rallies. We talk about decent month-long, multi-month rallies in markets from the lower position they're in. So you could see it maybe continue to hold around here, maybe even over the next couple of months push higher. But
55,
yeah,
56.
exactly, maybe. But if you get the next earnings season in June, or CPI prints in June and July,
or a big
GDP or something.
Weak jobs number.
Yeah, exactly. When it starts to filter through properly, then maybe you had the collision with reality. And you often see those lows retested. This is the key thing. Have we seen, was 4,800 last week and Monday the low? We don't know, obviously, unfortunately, but we often do.
Take us through what S&P earnings number you'd need to see for a 4,800.
So you'd need to see it come down. Where are we now? About 20, what are we now?
265.
265. So you need to see it come down. 240. I'm trying to do the maths in my head and it's failing.
Yeah. Yeah, to what, 240 on 20 times.
Yeah, so 240 would be a reasonable hit, I think, to earnings in the short term.
But from expectations in January, that is a 12% decline in earnings.
Which is a nice wipeout in terms of taking the froth out of this market. To take you back from the American exceptionalism, it's all going to be wonderful. It's deregulation bonanza that we just saw in December and January when everything... The problem is the market was priced for perfection then.
At 6,200.
Yeah, and now at 4,800, it was probably pricing apocalypse. Now it's somewhere in between in the short term.
Yeah. Good. Let's turn our attention to the FTSE. Right now, unfortunately, the FTSE is very China heavy in some of the weightings. Right, we've got HSBC, we've got Prudential, we've got Standard Chartered, we've got all the mining stocks. That's a bit of a tricky picture. That's why it's underperforming a little bit on the bounce back. Right, FTSE only up 5%. I never thought I'd hear myself say the FTSE's only up 5%. But let's take a look at what has been hardest hit. Now, this is thanks to the wonderful Bloomberg. We will make sure we get that in, so we don't get into trouble. We don't use it often, but I do think on this kind of morning, I've taken the April 2nd closing prices, right? So this is before the big orange buffoon came out and said anything about tariffs. This is the move from the close before tariff until last night. Let's run through what has China exposure, because you wouldn't expect those to be as strong this morning. They might get marked up on the open, but I'm not sure you get follow through of buyers. Standard Chartered, definitely Asian exposure. BP.
Yeah. Well, oil price, of course. So that's an oil story.
So so you need to see oil back up to 64, 65 before you get more of a bounce. Look, we're still talking about a 10% rally, right? BP was up 10% in the ADRs last night.
Yeah.
I would expect BP to be up 10. Intermediate Capital Group, I don't even know what they do.
No, pass on that one.
HSBC, definitely.
No surprise.
China exposure.
Literally in the name.
Yeah, literally in the name. Barclays.
Banking, I suppose, investment bank deals.
That's going to be strong, isn't it?
Yeah, I think you do well out of that. Melrose is engineering as well, isn't it? It's a conglomerate. I think.
Yeah, Melrose Engineering.
Was anyway.
Anglo-American. See that? I wouldn't. If Anglo's is up 10, I think I would actually short that rather than buy it.
Yeah, because miners have got a way to go to recover, really. But yeah.
Yeah.
And then Prudential.
But this is the problem is, do you now expect a Chinese a deal in the future, or will they devalue the currency? If they devalue the currency, the miners are in trouble.
Yeah.
Prudential Asian exposure, Glencore Asian exposure, Pershing Square.
Well, it's isn't that Ackman's thing, isn't it? Yeah. So he's had a shocker of a week on the Twitter. He's had a real up and down.
Angry Ackman,
because he was so pro-Trump and how wonderful Lund it was months ago, and then on Monday he was quite rude about him. And somebody clearly had a word because he had to apologise publicly.
Yeah. They do say when Ackman throws his toys out the pram, that's usually the low of the market.
Yeah, it's true.
That's his panic button.
What was that health firm he really went after? It'll come to me. He really went after. Yes.
Herbalife.
Herbalife, that's it. He really lost his stuff with that, didn't he?
One of the greatest arguments on CNBC of all time, Carl Icahn against Bill Ackman. Google it on YouTube. It is absolute golden.
About the third result on he said. 10 years ago, wow.
Right, let's go back to this list then. WPP. No,
advertising, yeah.
That's clean. That's a good one.
Okay.
St James's Place is a good one. And got to admit, they gave me a good fill on my pension. I put my money back into the markets from cash on Friday at noon, expecting them to completely do me over. They've given me a really good fill. So I'm impressed with that.
Nice bit of free advertising. Other pension providers are available, as they say on the BBC.
Yeah, I definitely wouldn't have my ISA with them or any wealth management. But, something that IG doesn't offer, pension. AstraZeneca, pharma's still getting nailed, isn't it?
Yeah, because it hasn't changed on farmers yet, so that's the key.
Okay, so Astra, Segro should be fine. Smith's Group should be fine. Smith & Nephew, fine. M&G, fine. Rent-A-Kill, still got rats. The Weir Group should be fine. Rolls-Royce. I mean, the airlines are going to have a cracking day.
Fantastic day.
Absolutely cracking. IAG, goodness only knows where that gets up to. Intercontinental Hotel, fantastic. Yeah, above the clouds, most likely. Scottish Mortgage Trust, there's one for you. Oh, I hadn't even thought of that.
Tech stocks all over now.
Oh, Scottish Mortgage is going to absolutely rocket. Just making a note of that. Nobody else touched that on the open. NatWest, they've given up a lot since that downgrade.
Yeah.
Lloyd's 64. Do you know what? I guess it's 11%. Was it at 72? We haven't had any news on the insurance stuff, have we?
No.
Claims.
The claims, no, not yet. No, that's going to rumble on.
Okay. Legal in general down at 217. There was some concerns, as Poppy highlighted, about their corporate bonds on their balance sheet as we started to see the stress in the bond market. So legal in general will be a strong day today, I would imagine, down 11% in the past week. In 10, yeah, people are definitely still going to gamble. So chart off. So that's us run through. You can see anything with China. Be careful on the open today. If it gets marked up 10%, I struggle to see that kicking on. We've still got that concern. But anything clean from China, including IAG, including Scottish Mortgage Trust, Legal in General, Lloyds, Barclays, BP, you know, if you've got those, I think you're going to have a good morning.
Yep.
Right, shall we have a look at the newspapers and see what they are making of this? What are we calling it? We're calling it a blink.
I'm calling it Blink Wednesday if you want to be cruel to the man. But yeah, I mean, it's...
Bond. What have we called the chat today, producer Phil? What have we called the show? Bond market beats Trump. I like that.
It was almost, I said this yesterday, it's probably a bit of hyperbole, but it was kind of heading towards a Liz Truss moment because it's confidence. Yeah. And I think someone clearly said to either Besant or to the man himself, or probably said to Besant, look, if you lose the bond market, the whole game is up. Mm-hmm. You can't, if you want to fight a war of the economic kind, or even, God help us, the military kind with China, you need the bond market on side. And I don't think it was, I know you probably argue with this, I don't think it was China deliberately dumping. I think it was just the fact you saw the stresses emerge, and there were just, because of those auctions that didn't go well, it was just enough that the signs were confidence was slipping away. It was a kind of mini Liz Truss moment. It didn't get to that you... That they didn't get to the same point, but it was heading in that direction.
Yeah.
And if you lose it, you can't get it back again. You can't save it, really. So it was best. And I imagine the behind the scenes, whether it was Sunday, whether he said on Sunday, because he was on the plane with him on Sunday. Yeah. Because if you look, you can see him behind Trump on Sunday. Whether he said, look, this is your line in the sand. If it gets to this point, we have to step back. And
Besant gave a terrible press conference yesterday and admitted that they had decided this on Sunday, right? That is why you had the leak from Walter Bloomberg. That was real. So the Monday leak of a 90-day delay, that the White House came out and lied and denied, that said it was fake news. That is a flat-out lie now.
Old communist joke, isn't it? Never believe anything until it is officially denied.
Oh, really?
In Soviet Russia, that's the line. So, yeah, that was... Since I believe Besant, I don't believe Trump saying, people were getting a bit yippy. This is my word of the week now.
Yippy.
Yeah.
However, can we just have a word about a 2:35 p.m. Truth Social message?
Oh.
Trump, in capital letters, be cool. Be cool. And then signed it DJT. Now, he doesn't normally sign off DJT.
No.
What are the initials DJT? That is the ticker code for his stock. Trump front run himself and told you to buy the stock market at 2:35 p.m. yesterday. And from then, you could see that the market was well bid, right? It tried to drop below 5,000 again. Nah. Every time it was getting frothier and frothier. The whole of the White House,
you can see there,
knew what was about to happen.
DJT.
Did he say this is a great time? There it is.
There it is on True Social.
Can we possibly zoom?
Can I zoom in? Oh, I can't on my thingy, but
maybe. Do you do that on your?
Can I do that? There we go. Oh, well done. I can't do math.
What? This is a great time to buy. How can this be allowed? Oh dear, I missed. There we go. Be cool. Everything's going to work out well. The USA will be bigger and better than ever before. This is a great time to buy DJT. That was it.
Trump said, Besant said I was sitting in the room while he wrote this one, the based on lack of respect one that was released when he announced. He said they were all in the room together while he wrote it. So.
And this is a problem, right? Chart off, guys, thanks. This is the problem now, that we don't really know where we sit with China. We don't know if this is posturing. He came out in the press conference and says they want to make a deal, they just don't know how to make a deal. I think they do. So yeah, let's keep an eye on that one. But tricky one to call on China. However, let's have a look at the futures price. What are we looking at this morning? We're looking at up 5.5% on the FTSE 100. Only takes us to 8,070. That's how depressed that index was. Germany, a little bit punchier, up 7.8. Euro stocks up 8%. The volatility contract. Now, we saw vol peak at 35.9.
On the platform, yeah.
What's the stat you've got about the rate?
Okay, so if you look, this is from quantifiableedges.com on Twitter, which is a really good site. They look at studies of when X happens, what's the result over the next few days. And this looks at fixed declines of more than 10 points in one day. And this is from 1990 onwards. If I zoom in, I'll lose most of the chart. So you can see that 2025 creeps in here along the bottom.
Right.
But previous instances, you can see the red. It speaks for itself on that point.
But on the percentage change, it's the biggest ever.
Yes, the biggest ever percentage change in terms of that.
A 35% drop in the VIX in one day.
But if you look, the previous times we've had it, it's obviously clustered in 08, 09, and then you've got one in 2020. The interesting one, maybe, perhaps the closest parallel, and because it's closest in time, is 2024 with the yen, because that maybe shows you how the VIX is changing and evolving, that you did actually see it continue to rebound in the next 10 days. But in all previous instances, the next sort of 7, 8, 9, 10 trading days saw the S&P continue to struggle. So it's kind of...
Sorry, that's the S&P returns.
Yeah, so it tends to continue. The market doesn't do fantastically well. The number of wins, it doesn't win over the course if you go along. So you tend to see it's not a massive decline.
Oh wait, you can disregard because
I think you could probably take out that top one because of the bigger crisis.
2010 makes sense.
Yeah,
that must have been a European crisis.
Yeah, there
11 was European. That's the one I would believe is the 9th of August 2011.
Is that Europe or is that debt crisis? Is that US debt crisis? That's US debt ceiling, isn't it?
Was that the debts? So that's what this is closest to, right? Because it was panic. Okay, we've removed the tail risk, we've removed the panic. So there we go, down 35 basis points today. Funnily enough, we're sitting at down 50 basis points. And then a 1%, it's a 2-day change. So that means net. So on Friday, we'll be up 2011. So where am I looking now?
Oh, it was the debt crisis. It was over the concerns of France's AAA rating and also US economic growth and the US credit downgrade. So that's kind of the... Okay. Because S&P downgraded the US on the 6th of August. So that's what is the bigger move there for 11. But
okay, yeah. So the important thing there, let's look at the 5-day net change. Both in 2010, 2011, you can see they're either down 2% or up 2%. That is what I think we're in now.
Yeah.
I think we're in, the vol's gone, the vol's not coming back to the same degree that it was. And a week from now, 5,300 to 55.
It could well be roughly where we are now. I think you'll get a lot of movement, but not much direction, maybe, compared to where we were.
Great. Right. Let's 7:54. We'll take a quick 2 minutes. I need to go and grab a coffee, and we will be back for this UK Open.
Tesco numbers
and upgrades, downgrades. We'll see you shortly. It's going to be an exciting Open. Go and grab yourself a coffee. We'll see you in 2. we've lost him. Too much excitement for Beecham. He's gone to make himself a coffee. And unfortunately, I was in front of him in the queue. So he's had to take it. Here he comes. What happened to you?
You should let me go first as the guest.
The guest.
The on-air talent.
Good stuff. Thanks for joining us. Right, let's take a look at the economic calendar there. What is coming up today? You'd forgotten, hadn't you? It's CPI day.
Yeah. Nobody cares.
Nobody cares. Well,
I don't even know what the expectations are. What are the expectations?
the expectations are for...
Oh, point...
Cool, this is going slow today, isn't it, on the old economic calendar?
0.1. Oh.
Yeah, 3% on the core is the estimate. And then on the headline, 2.5. That headline's coming down quite nicely, actually.
Yeah, it is. And the core month on month is supposed to come down. No, it's supposed to go up, sorry, from 0.2 to 0.3. But it almost doesn't matter because it's not going to be the CPI for the next couple of months that matters because you want to see what happens with tariffs. So maybe next month matters a little bit more, you can argue.
Yes.
5 Fed members speaking today. So that's interesting.
Right. Oh, TPE's done me, hasn't he? Yes, the presenter remembers that he's taken everybody for drinks. The bar is open and it is on me. We're going to have a social, people. We're going to have our first social. Everybody on the chat is invited. And yes, I said if this market closes above 5,400 yesterday, the drinks are on me. So first round is mine. There we go. There's the poll of the day. Does Rich owe everybody a drink? He bloody does on that performance yesterday. And big shout out as well. I got a wonderful message at about 4 o'clock this morning. I think he must have still been out celebrating. Conrad had the daily expiry call option on. So well done, Conrad. And well done anybody else who got that in for 3, 4, 5 ticks. I hope that paid off nicely. Right, we've got about 60 seconds left. Quick word on Tesco numbers.
Yes, Tesco full years this morning says highest market share in years like-for-like sales up 4% versus estimated 3.9%. So, but they did cut operating profit guidance for the next year.
Oh,
to give flexibility and firepower to respond to current market conditions. I think they're...
they probably get away with that, don't they?
I think so. There seems to be a logic behind it. But yeah, so in numbers from Tesco this morning.
Mind you, remember that, the best performers in the FTSE are going to be the underperformers today.
Yeah.
Right? Tesco,
Sainsbury's and M&S all up over the last week. Sorry, I've stolen your thunder.
No, not at all.
So we were looking at them yesterday, what was survived and what didn't survive for the last 5 days. And that was the supermarkets, for some reason, did okay. And Admiral...
Water companies.
Yeah, Imperial Brands, United Utilities, they're all up over the last 5 days or so as of...
Right, so that's your big underperformers. You've also got ex-dividends. We're going to go through who the ex-dividends are. Be careful, because there's quite a few of them. So let's get those ex-dividends for you. Do you want to do the honours, sir?
Delighted.
Here we go. There's going to be a lot of stocks delayed as well, so we will have until 8:05 for a lot of FTSE stocks. I think we've got ITV and St James's Place. So if you're buying St James's Place, remember there's a dividend in there to come out today.
And Lloyd's.
And Lloyd's is ex-dividend as well?
Lloyd's, according to my...
How much is that?
Nearly 3.3%, dividend of 2.11 pence. So, and Reckitt's to 2.5% impact.
Hang on, Canal Plus, what's that come down from? Canal Plus from 170, right, well that one's getting bought first of all, there we go.
Canal minus.
Right, Canal Plus, I buy 2,000 at 157. That is the first one of the day. Remember, that is not in any index. There's another one to get as well. Where is Havas? Havas trading up 7%. Missed that one. Yep, straight back to where they were. So that's interesting. Havas, remember, the other part of the Vivendi, that has rallied back to where it was on Thursday. Canal Plus has not. That's an interesting one to take note of straight away. BAT up 70 basis points. Might not be there for long.
No, they were okay over the last week, weren't they? So.
I would suggest let's sell some of those 1,000 shares.
Oh.
Is that right? At £31?
Yeah.
So, yeah, boom. Right. Selling BAT at £31. I think that's just getting marked up because of its index weighting, and that will come off as the day goes on. Banks all on call, so that's a 5-minute delay now. Chris Beecham, run us through those big movers.
So, builders, Travis Perkins, everyone's going to be doing DIY now the tariffs are off, 6.2% on then. Persimmon as well, Travis and Kingfisher, so that's interesting, and then Persimmon and House Builders. And of course, your favourite, Vodafone, up 4.2%.
Vodafone up 4, that's not enough. Come on, it was 71 before. Are you kidding me? Vodafone 66 pence.
It feels like a buy everything kind of morning, and then we'll see when the dust settles in a couple of days.
Anything that doesn't have a business in China, and I'm sorry, Vodafone does not have a single
Not yet,
SIM
anyway.
card in China.
Marks and Spencer, didn't they try entering China years ago? They did, didn't they? I think twice they've tried to break China.
There we go. There's Bats getting smashed. 30.80. We're already up 20 pence on those. Reckitt's 47 quid. Reckitt's an interesting one. Everything else, as you can see, looks like it's opening up more than 5%. As I say, St James's Place, be careful, ex-dividend. Lloyd's, be careful, ex-dividend. Do we have an amount that it's ex-divvy?
Lloyd's,
Yeah.
3.3% dividend impact, or just shy of 3.3%. So Lloyd's, Aviva, St James's Place, Howdens, Reckitt's all this morning. So fairly chunky ones on the FTSE 100.
Right, the Germans are open, 70 euros trading, up 10% on BMW. Mercedes up 9, Adidas up 10. Didn't even think about Adidas.
Sprinting ahead.
Sprinting, hot off the blocks, up now 11% on Adidas. Not often you'll hear Chris Beecham crack a joke.
No, they make shoes for sport, I believe. But who knows?
It's not the normal 3 stripes you know on the shoulder, is it?
Exactly.
Porsche up 10, Lufthansa, all these stocks getting marked up. Lufties, that is interesting.
Wait to see what IAG was.
No, IG won't be open, I'd imagine. If it is, get involved. Siemens up 12. Rheinmetall, let's see where Rheinmetall...
6.7%.
Only up 7. What did Rheinmetall get to at its highs? 1,600?
Something like that, yeah. It dropped 20% in a week, didn't it? Or
Yeah, right. Not going to touch that. Volkswagen up 90. What about the ones that haven't really moved? Let's have a look at those. Those might be more interesting this morning. E.ON, understandable. Nestle, Deutsche Telekom, all boring and defensive. What time? We got 1 more minute. 1 more minute until we get all these big names open. Look at all the ones that haven't opened. Quick check on what the FTSE's doing. We've got FTSE up 6%. It's had a rally on that open, so it's awaiting these big moves that are about to open. Update on the S&P up, down 30 basis points. Makes sense. Right, for Expo up 11. Canal Plus now up 7. That's more like it. Get going. Oh, that's a nice quick 2%, isn't it?
blimey, look.
Let's see if we can do more of that.
But this is the sorry to be boring. You won't stop me, but there you go. This is what you just see in bear markets. You see it go up, you go down a lot, but you go up a lot as well. So this volatility is just a given.
Scottish Mortgage only up 10. Only. BP up 9.5. That's what it was in the ADRs yesterday. So that makes sense. Smith's Group up 7.5. Canal Plus, Travis. Where are those miners? Where are those miners? Barclays up 24.
Look at that.
Are you serious? Jesus Christ. Excuse my language, but I did not. Wow. Go on, Barclays. Get that in the ISA.
Basically, right back to where it was January and February before this happened. It's incredible.
Oh, has somebody been stopped out on that? That seems too much.
That finger?
So where is Lloyd's then? Right, Rolls-Royce up 16, Burberry up 15, and Anglo's up 14. Ooh, I think that might be too much.
Burberry's interesting. It's supposed to be a China story. Interesting.
Yeah, just be careful on those, right? Burberry, Anglo's, Antos, all China stories.
Burberry's still heavily shorted, isn't it? I think.
Like I wouldn't short them, but beware. Yeah, look, Barclays already coming back. That was ridiculous. 25%. Somebody's been stopped out on that for sure. Scottish Mortgage Trust up 10.5. That sounds about right. EasyJet only up 8. Let's look at where EasyJet was a week before. Yeah, okay. No, that's up.
Because I think you'd see IAG up more when it opens because of the business travel angle. I think would be the way to look at it.
Yeah, IAG not
so
yet.
Don't get that with EasyJet.
Let's
waiting.
Have a look where IAG was on the 2nd of April. IAG at 2 o'clock was at 260. That is 11%. Is it more? 37? No, that's more, isn't it? 37 is 15%. Expect IAG to open up around 15%, I would think. And that only takes it back to where it was. Actually, no, it's going to be more. You would think it would go back to, tariff. No, tariff, that's right, isn't it? Mm-hmm. Yeah, 255, 260. If I was a market maker, I'd make 255, 260 on IAG. Let's hear in the chat whether you think it's going to be more or less. Does Barclays deserve to be up 21%? Who's got it? Andrew McKelvey, great spot yesterday. JD Sports already up on a earnings release yesterday. They did a trading update, and the trading update was good.
Yeah, it was. I saw they're up on the top mover on the 350 yesterday. I saw that. Interesting.
Right.
No IAG yet.
No IAG yet. Interesting.
Still in the departure lounge. Not yet.
Still, it's delayed. Not like
any BA flights. No, that never happens to BA.
Right. Where is your departure level in IAG? I'm making 255, 260. I want to see who's trading. Guesses are it's more like 257, 262. That's what we used to do pre-market. On the trading floor, I would be wrong in Barclays today. I would only made them up 14. Rolls-Royce up 12. Right. What about on the downside? Are we seeing
anything?
Tesco's down 5.
There you are. The 3 that were gaining. So yeah. Well, I suppose on that kind of morning.
No, but this is the warning on last year.
Yeah. This is
next year. Sorry.
And all 3 of those were up over the last 5 days, so they are just taking a bit of a hit proportionally, maybe a bit exaggerated. Sainsbury's particularly because Tesco was saying they're cutting their profit forecast because of the risk of higher competition. So they're on such wafer thin margins.
It's the Asda. Anyway. It's the Asda effect.
The Asda's, the Lidls.
Makes sense. Right. So yeah, Rio's BHP up 6 and 7. That's kind of typical for them. Hesitating a little bit on any move. What about the kind of the mid-pack? Unilever's National Grid's up 2.
National Grid had a trading update this morning, but it only said they're in line with forecasts, so it was a bit dull. But I'd have thought maybe a bit better because of their big US business, but there we go.
Oh, Diageo up 5. Now, how do the tariffs change for Diageo? 10% across the board, is it?
So for the moment, 10%, so that will make life a bit better for them.
Did he change Mexico and Canada?
No.
No, I think Besson confirmed that Mexico would only be 10% now. I'm not sure on that.
Really? It's so hard to keep up with what they're doing.
Yeah, but that was just the reciprocal, wasn't it?
Did you see the European Union didn't decide they weren't going to tax bourbon this week? They said they were thinking about it, but they're not going to. So there you go. You must drink the stuff.
Diageo at 21.
Nearly a 4% yield on Diageo at these levels on a P of about 6.
That Vodafone's wrong. 65.80. The stock was 71. Come on, let's see the graph. Let's see where this gets back to. Yeah, Friday midday, it was at 68, and now it's at 65.80. That doesn't make sense. I'm having some more of those. I'm
The
sorry.
market's wrong. You heard it here first.
It's that one. All right. Do you want to buy Barclays up 25, or do you want to buy Vodafone when it's?
You're very good at rationalising it. There you go. That's the most important thing.
See, Barclays up 18. Why didn't you short that, Chris Beecham?
Yeah.
Right, the Carnival. That's right. It's time to be dancing on the streets of Brazil. Up 18% if you're in that one today.
That's not a good joke. They're a cruise line. They're not. This would be. There's a better pun there for you.
What, have you not been to Carnival
Sailing
in
away.
Brazil?
No. Does I look like a?
I can imagine you in the little head outfit and everything. Yeah, Barclays on call. Obviously, a lot of trade going on in that one. IAG, we still haven't seen it. What is going on IAG? Is it up and we just can't see it? Producer Phil, have you seen any trade?
Someone get the desk in. Where's Ronnie?
Prudential up 8. WH Smith was one that would be interesting. Where was that one as well before? I've lost it now. Where was WH Smith? There it is. Right. Where was WH Smith at lunchtime on the Friday, the 4th? Yeah, it's gone right back there.
Because this is a travel story now, because they sold the rubbish high street division, so it's all about airlines, isn't it? So there's this air travel going back again.
I guess you get a small negative read from Tesco for them just because it's a shopish.
No, but it's a different sector. It's airports and stuff for WH Smith now, and the high street's irrelevant. So
more UK consumer though. I mean, okay, a holiday's a different thing.
Yeah, it's all people buying overpriced paperbacks before they go on holiday.
Oh, you don't like paying for your bags, do you? Right, chart off because my computer's about to die. What? Shall we check the commodities? Do you think? IAG looking at 272. Thank you, J Mac. I would have been taken out of them. I would have been taken out of them pre-market, definitely on that poor price. No, Tesco's down 4, Blake 7, not down 12, maybe 12 pence is that? Yeah, 12 pence. So IAG looking 272 tells us J Mac. 272 takes us back to where, Chris Beecham? Because
I don't know. Bear with.
272 takes us back to
Friday,
the 31st of March.
Okay, so 2 weeks ago, roughly. Yeah.
That doesn't make sense. Why would IAG be higher? I'll tell you what. Let's look at Delta Airlines. Maybe it's just a follow of Delta.
They cut their guidance yesterday, didn't they? They cut guidance. So whether they reinstate guidance now, I don't know.
Right. Friday the 30th, Delta we're trading at, yeah, that's why. IAG's at 272 because Delta got up to their 30th of March price yesterday. I don't know. Did EasyJet though? I guess it's people are more likely to fly to America now, aren't they?
Yes. Yes, there was a stat about tourist numbers to the States have dropped precipitously over the past month, because people worry they might get picked up by ICE and deported again or whatever it is. Because a few of those stories are doing the rounds. So
yeah. Would you be heading over to New York? Would you think twice about it?
Yeah, I might leave off for the time being.
Right.
I have no wish to see the inside of American Detention Centre. I don't know.
Oh, goodness. It's one of the scariest things, no matter what, going through customs in America.
Yeah.
You can be the most innocent person in the world. Mother Teresa would get nervous.
Do not crack a joke because they do not take it well. You know.
No, not at all.
A little bit humour.
Yeah. Haven't been to Chicago yet. Looking forward to get over to see the guys in Tasty in Chicago. Hopefully I'll get through customs there if I say who I work for. St James's Place up 10 with a dividend.
Okay, so you should factor that. We should have been up, what, 12, 13, I suppose. What was the dividend impact on them?
That's interesting. That's because they gave me a good fill. We won't short that one.
Oh, this is the fourth time you've mentioned that.
Right, Glencore, still only £2.60. Find that incredible. BP,
still nothing on IAG.
Interesting. BP has not rallied more than 8. let's see where that one's sitting relative to April the 2nd. The reason I keep on mentioning April 2nd is that was when China retaliated, and that's when all logic went out of the market and vol started to explode.
Shell's up 7. What's BP up by? 5, did you say?
7.8, 8.4, sorry. Right, BP on Friday afternoon was 381 pence, and it's now 361. The oil price has collapsed, but is BP an oil price story?
No. There's bigger concerns, really, isn't it? This slow turnaround program, and the chairman's leaving as well, isn't he? I think he's going next year.
Gone, yeah, but I think he'll be on the beach already.
Yeah.
Right, have we got IAG open yet?
Not as I could see it.
Why is Barclays open up 25%, but IAG doesn't? London Stock Exchange, give us a call and explain that one, please.
Interesting.
Now Barclays, that 15% is much more believable. Somebody clearly got stopped out in Barclays, one of the hedge funds, and was a forced close on
Look at gold, 3118 on gold.
Yeah.
Back again.
Quick, since we're talking about all the commodities, Chris Beecham, run us through what you're seeing there.
So gold and silver, the big winners of the morning. Big winners yesterday as well. Gold back above 3,100. Silver absolutely storming higher from last week. We're down at 28.50 last week, up above 31 again this morning. So very solid performance. Oil prices, of course, huge winners yesterday, but coming off quite a bit in the short term here. So that's because that doesn't take away the story if he wants to increase production. But there was a lot of comments saying, but you just won't get the US producing because their cost of production is so much higher than Saudi. So there's just not that desire.
Okay, let's look at where Exxon, what was it, ZOM?
Yeah.
Where did Exxon get back to? They got back to Friday at 5 p.m. So that's interesting. Exxon has bounced despite oil price weakness, and BP hasn't. Or not quite. Yeah, another 2%. So BP trading 7% lower than it was at Friday lunchtime. Exxon only trading 2% lower. That's a potential pair trade on the open. Chris, are you having fun this morning?
Isn't it fun times? This is the kind of thing you just live for in a way, because it is. I was talking to Reuters yesterday. We were both saying that obviously when you're talking about markets, and especially when they're going down, and there's the risk of, IAG up 9.6%, 257.6. So I'm told.
Oh,
so there you go.
I mean, you'd almost think somebody made the right price pre-market. Why was that? It's 272. What a load of rubbish.
But yes, it's. Just give the movement are just manic, and it's just all over the place, but it does mean you've got so much you can just write about, think about. It's so much more interesting than a market that just quietly goes up every day.
Are you saying Trump's actually of benefit to
for a purely me sitting here writing about stuff? Yes, that's all I'll say. That's as far as I'd go. But yeah, the key worry I think today is what happens if China responds again. How will markets take this if they come in and go, well, let's go to 100%? Because they are playing escalation, really.
I would worry about that if Trump hadn't clearly stated yesterday, China want to make a deal. They just don't know how to make a deal.
Is that going to annoy them now? It'll annoy me.
Yeah. But he is an annoyance, isn't he? I mean,
yes, no, it's very true. But this is the kind of thing: is that China will go, well, we're not ready to make a deal yet. We think you've probably been unfair.
But the deal's clearly on the table, right? The deal was offered to them yesterday. I think Besant offered them the deal at 1 p.m. He said it is a shame that China are not interested in negotiating. To me, that's a diplomatic offering. It's a offering the handout.
Yeah.
Because it's saying if you want to negotiate, we're ready for you. Right. Well, how has that left us on the actual markets then? 50 basis points down. FTSE holding 8100. That's interesting. I don't see Legal and General. What's
Oh, I've not seen them yet. Hang on.
Right, chart off, please, guys, and let's just have a...
Legal and General up 6.7% so far this morning.
7%, right.
Up at 233.6.
Okay, just checking my UK options.
There's a lot of red there.
BP, yeah, still. I know it's yeah, Vodafone's marking wrong. That's why. Yeah, beware on your UK options. There's been wide prices the last few days, so no, that's not to go up, guys. Thank you. You can if you want, but it's yeah. There's no point because a Vodafone 62 put, for example, is marking 2 to 8.75. So I'm showing down £7,500 in it, and its correct price is probably about, I don't know, 3-4, something like that. 66 puts are the same. Yeah, Tesco down a bit on the £3 puts this morning. Okay, yeah, go on, put the chart up, and I'll show you what I'm talking about then. So this is the portfolio that's really killed me over the past few days. BP 420 puts, right? So I'm getting murdered in those. I think I'll probably roll those down, but they are trading at let's see, 57 to 70. Yeah, 57 to 70. So there you can see the P&L there is showing down £9,000, but that's because it's marked on the offer. So there's a £3,000 difference between the bid and the offer. This is the problem on your UK options. Legal and General, the same. Let's see where Legal and General's marking 7 to 18, right? So again, when you've got a position of 30, that is £3,000 difference. So all in all, you're kind of getting hit for about £3,000 on every position. Even Tesco's is 214. So you've got to be careful when you're trading UK options. Unfortunately, not nearly as liquid as the US ones. Good. Right, Christopher Beecham, I think we're going to let you off duty.
Oh, thank you. Some headlines just coming from China.
Oh, go on.
There is no winner in a trade war. If the US insists on its own way, China will follow until the end. We'll take further measures to oppose US bullying. So just kind of what we heard already in the week, but just watch that one. It's not, this trade war has not gone away, I think is the message.
I wish, can we not just get them in a room and chat?
Hash out.
Yeah.
Can everyone just get along?
Yeah. Because they just don't know how to make a deal, that's why.
No.
Right. Got to do this moment. Fantastic. Excuse me. Fantastic in the chat this morning. There's some great comments from you guys. Arthur Fox Haig, I'm very glad to see you on the chat this morning asking, did everybody survive Trumpageddon? I like that a lot.
I survived the great trade war of April 2025. Yeah.
Should we get T-shirts made?
T-shirts, yeah, exactly. Yeah. What did you do in the great trade war, Daddy? That poster, yeah.
Right, so if you don't mind, please give us the old like and subscribe. The thumbs up is the best one on the chat there. Yeah, give us a like, give us a subscribe. Tell everybody that we gave you 10 hours notice that the market was going to close at 5,400 yesterday. Did you get in? I certainly hope so. We're going to hear if Martin Harris did in a couple of minutes' time. We'll see you in 2 after the break. Give us a like on the chat. My brew is back. Martin Harris, words of wisdom the other day. That was you gave some great messages. So go on. I dare you today. Give the same.
New ones though. New great messages. Okay.
Where were you when it all happened? I think. Do you want to just pop the seat up a little bit? Where,
Okay.
Yeah.
Okay.
Let's go on. We got you. If you just give the gas a little, we want to get him up. Yeah, but you've got his computer in shot, guys. Right, there you go. Live television, ladies and gentlemen. How about that? So, Martin, take us through where you were at 6 p.m. yesterday.
6 p.m. yesterday. Interesting one. So I'm actually sitting at the oyster shed after a day of just market.
This is why I didn't go.
Just brutal assault on the markets.
Uh-huh.
Aaron Bright, assistant portfolio manager of IG Smart Portfolios, turns to me and says, "Have you seen what's happened?" And I'm thinking, it's gotten worse. It's like, what? Why did I close my short position? Something like that. So pull out the app, and it's popped up, considerably. So, yeah, I think it's really helped out a lot of investors. I think the last week has been tough. I think that the difficulty around this entire, for me, the entire sort of tariff scenario has been how broad-based the effects have been.
Definitely.
There haven't been these clear winners. Even bonds have sold off because people have had to sell bonds to pay for their risk assets. It's been remarkable. And so this puts, the trouble isn't over. Effectively, there's still a 21 percentage point import duty on average on US imports.
Now, to explain that, break that down for me. So at the ports, or however the goods are getting into the country, prices are 21% higher than they were a month ago.
Yeah, so exactly I think basically from the beginning of the year, if you take the bulk of everything that the US imports, the autos, the auto parts, certain goods. Now we've got these exemptions, but when you take the weighted average of what they're importing,
who cares about cars though? If you just don't buy a car. I mean, essentially, for the stock market, for the global stock market, I do not care about cars.
Oh man, you're almost ready to buy a 911 Porsche, aren't you?
Footsie, right?
No, exactly. I hear what you mean.
Martin all the way.
But I mean, for Donald Trump, the cars were a massive thing from I think a psychological perspective of this is where we deliver jobs, and so that's why the cars are getting hit, because there's a big kind of emotional reaction to the US being a car producer, and they need their cars to be more competitive, and they don't export a lot of cars. Europe does not consume American cars. You do not see F-150 trucks on the road. You don't see Corvettes, things like that. So
that's because the government charges too much on gasoline.
Exactly, and they don't fit anywhere. So it's kind of like if they just changed the product, they'd probably sell more of them. Anyway, so that's one of the things. So there's still going to be increased cost. The fears of recession are not averted. The concerns around earnings, the concerns around inflation, not averted.
Take us through that. What's your concern now around earnings? Let's say today, right? Now, Tesco, right, the least affected of any global retailer, you would think, right? Doesn't buy that much in from China. They've taken guidance. Who was it before? Who was it that retracted guidance? Diageo retracted guidance. Today, here and now, what do you think the earnings effect is? So a 12% expectation of 12% growth in January.
So I think one of the things that we can look at is are each of the exporters going to just increase prices in the United States? Mm-hmm. One for one with what the tariff looks like, which is unlikely. So what they may do is they absorb some of that price increase, and they increase and they compress margins across the globe. And so even though you're in a country that doesn't have the tariff increase, in order for you to offset sales that are happening in the United States, that is the concern that we have for some of these producers.
A 10% tariff on the cost of goods sold is nothing on the end price. It's like 2%.
Oh, it's not what we need during an environment where inflation is a problem. And so because we've been driven by the services inflation, has not come down.
Yeah.
I think something I shared with you a while ago, particularly in the UK, we've basically got a 1-for-1 increase in cost of goods sold with wages increased, because there's been no productivity increases. So as soon as there's a wage increase, the cost of what you consume goes up. And you can see it with the likes of your Tesco meal deal has now, Sainsbury's gone up to £3.75 from £3.50.
You've been watching this carefully, haven't you? Yeah. That's hit you where it hurts.
M&S now £6 from £5. You know, big jump.
More of a dine-in, the 12 quids.
Oh, okay.
With a bottle of wine.
Understood. And so that stayed at 12?
I think so.
Okay, I'm not too sure. Okay.
I started cooking for myself, so.
Good man. So that's where, you know, so they either deliver these.
Sorry to interrupt. Just be careful on this market, right? On that China headline that Beachy just gave you, we are seeing the S&P down 53.80 now, down 1.2, Nasdaq down 1.6, still a bit twitchy. FTSE still up 5, so that 8,100 is gone. But you're just getting a little bit of a drop. Volatility up 6% on the day. Trump going to be waking up to an aggressive China, but, you know,
no, exactly.
deal at any point.
So, and I think this is something I mentioned to you just briefly. I think that there's going to be some of these sales are not necessarily driven by market moves, but are just going to be a function of people almost out of sheer exhaustion. So the market went up yesterday. All right, let's take some off the table. So there's going to be that element as well.
Yeah.
One of the things I wanted to remind listeners of, or viewers, is of diversified sort of 60-40 portfolios again.
How's that done in the past?
So this is the thing, is that the smart portfolios, our aggressive portfolio, heavily exposed to a US market, which did really well last year.
And remind what percentage?
So in the smart portfolios, I'll just go through it very briefly. We've got 5 portfolios. Mm-hmm. The conservative portfolio is portfolio number 1. All right, yeah. And that is a fixed income only portfolio. It mimics something that it mimics something that you'd get in a money market fund.
Wow, that must have done well.
It's done all right. Mm-hmm. So even at the short end of the scale, markets have been affected. There's been a sell-off there. So you're getting the equivalent there of, we're aiming for between 4.3 and 4.5% returns. And when you then look, and on the aggressive side, we're going to almost 90% equity exposure with 10% into alternatives, fixed income, and things like that.
Okay.
Right. So we're using.
That's been murdered.
I mean, murdered is it yesterday recovered with. So yeah. For the year, not murdered, but yes, for the last 2 weeks hasn't been great.
Yeah.
But if we go into the middle of that and we look at like a balanced portfolio.
Did you see? Sorry to interrupt. Did you see many people transfer from 5 to 1?
So towards Donald Trump's sort of inauguration, people were getting itchy and the market was rallying, and we saw a number of clients actually move from 5 to 1 around that time, and they missed out on some large,
aggressive to defensive.
Yes, aggressive to defensive.
Yeah.
Exactly. Yeah. And so, the viewers can look at something like that for their portfolio, if depending on where they are, is that they can move into a slightly more defensive position and they can use more fixed income at this point. If we are entering into a recessionary economy, prediction from Goldman Sachs is that at present we've got 3 cuts priced in. If we go to recession,
let's do
200 basis points.
Let's do an update of that. So Fed Watch, let's even in 24 hours this is going to be different.
Every day we give you a new one.
Comparison. Let's look at June, because June's the most interesting meeting. So this would be unchanged, 425.50. This one here is 1 cut. So on the on the, where are we? 3rd of April, we've gone exactly back to where we were on the 3rd of April. Interesting, 63% chance of one cut in June, the first cut by June. 2 cuts has dropped significantly yesterday down to only a 12% chance. And you see unchanged gaining up to 23%. Now let's look at December quickly. Martin, take us through what we're seeing here.
You're the expert on these charts. I'll leave it to you.
So yeah, so there we go. So 18% chance of one cut, 33% chance of 2 cuts, 29% chance of 3 cuts, and an 11% chance of 4 cuts. Market doesn't have a clue.
It's been testing times. I mean, I prepared something to present yesterday morning, and it's completely out the window. So we're just rolling with it at this point.
Great. Okay, so yeah, definitely consensus is for between 2 and 3 cuts, with 2 being the most likely.
Yeah.
But
so my message around that is that if we've now had Trump respond, markets have the free fall has eased. We've had a bit of a recovery. If this doesn't stabilize, and so it has stabilized somewhat, if we don't continue a stabilization pattern, then really up until now we've had just a paper earnings kind of devaluation. If this crystallizes, that's when if we don't have a decent recovery or
what crystallizes on Main Street?
If the losses in the market crystallize, that's
the wealth effect.
Exactly, and that's going to knock on to particularly employment, and companies start laying off people. Their capex gets cut. The increased cost of even building infrastructure for the hyperscalers to go into AI, bringing chips over from the Far East. All of those costs go in. They need to, they're not making more money. If they want to build at the same rate, they need to cut costs somewhere else. And that then trickles into the market. That's where we get the potential earnings recession. And that's what my main fear could be. However,
makes sense.
Donald Trump could cut another deal, extend the tariffs.
He's the master of the deals,
yeah.
Martin.
This is the art of the deal, I guess.
Isn't he just a joke now, though? You cannot believe a word he says. He decided on Sunday he was going to do this. And he lied for 48 hours straight. For 72 hours straight, he lied to the American people, to the world, to the market.
My next concern is that if there was that tweet that came out of that there was going to be a delay, and markets shot, it was like, over in 20 minutes, Walter Bloomberg. Mm-hmm. And then 2 days later, that's exactly the news that comes out.
So it was a leak, not a fake news.
There you go.
And they flat out lied to the American people, to the market. Right, let's have a quick look at what these earnings estimates are then. There's revenues. These are the numbers we care about. The green dotted line here, can we go full screen on that, please, actually, Terence? Thank you. So the green line is 2024, right? And we know that came in at 246, was it? Around about.
It was just under there.
Around, yeah, 240, say 245 for ease, right? That was the earnings, EPS earnings of last year. There we go, 245.17. The purple line is the expectations for this year, right? And as you can see, they've been coming down from, 275 to current day around 270. Let's see if it's got that for us. 268. So we still expect earnings growth of 244 to 268, which is 14, which is 6%, right? Is that wrong?
So this is, I think that this is built in with the presumption that the amount of trade or the amount of earnings remain on trend, mm-hmm. potentially then with a discount to what the tariffs could potentially look like. if you get a situation where there's a larger knock-on effect because you have this aggregate demand shock because less foreign goods are also being bought,
Yeah.
these could these could be lofty estimates, and so this could come lower.
Could we be as...
I don't think we've priced in the demand shock.
Is it arrogant to think that earnings could be up compared with last year? We're already a quarter in. So that quarter was a beautiful quarter,
Yeah.
the best quarter in history ever, right? So we've got 3 quarters of, no earnings growth?
I mean,
Or is the Q2 still all right? So then it's the runway into H2 where we start.
Q2 should still be fine, and there's been a lot of reports of also consumers and businesses front-loading purchases right now in anticipation of tariffs.
So it could be better.
So we could potentially have, a somewhat higher sort of surprise.
Yeah.
If you now get a situation where Donald Trump further extends the delay to where tariff kicks in, then those orders might, just be replaced and moved to another quarter. It's a difficult one to call.
Q2 is better than expected. Q3 shocking, which means that in earnings season, you can take that chart off. Thanks, guys. In earnings season here, the numbers are fine, but the guidance is shocking.
Yeah.
Because they just do not know how much inventory build's been
exactly,
already
and
done.
the guidance is where you get the surprise moves in the market.
Yeah, right. So there we have it. What are we sitting at today? If we're at 5,400, right, and we are talking about an H1 of 10% earnings growth, gives us 270, 135. So 135 of EPS in H1, and then more like 120 of earnings growth in H2. That gives us a number of $255 of EPS. Do you stick that on 20 or 25? 20 or 21?
21.
Okay. So 21 times 255 equals 5,350, and there we are. So the market has got it right. One worry is that you've got declining. We're 17 points off the exercise that we just did. Yeah. Not even 30 basis points away from what is fair value of the fundamental scenario we just worked through. Is it 20 times earnings? Is it 21? Do you read through the H2? If H2 continues into 2026, right? 2026 numbers are expectation of 300. That is cloud cuckoo land. If you're on a run rate of $120, that's 20% earnings downgrades to come through to 2026. Or it doesn't matter because tariffs are a one-off thing.
Tariffs are a one-off thing. There's also expectations that the deregulation is going to boost the market. So, I mean, potentially...
And tax cuts.
Tax cuts, the deregulation, the boost to also shifting this crowding out effect that where the federal government in the United States were, playing too much in the private space. They remove themselves, the private sector becomes larger and more profitable in the United States. So that was, the view, is that they could shift a lot of the economy out of the federal government back onto the private sector, and that should pick up all of these jobs that they've laid off in the Fed. So those are kind of the 3 sort of pivot points, and then also what we do have now potentially lower energy costs. So
true,
lower energy costs. Lower cost of debt, supposedly, is the view where they want to get to.
Yeah.
Right. Lower interest rates, and AI boosting the productivity of every sector in America.
It's believable. Believable. I think that you've got a market now where the tail risk is gone, right? I still think we can maybe see 5,200 kind of thing, right? Because that's your 21 times, worst case scenario is 21 times 240, which is 5,040. So my low, 5,040 plus dividends, 1.5%, yeah, 5,100 and change. I can see that, but that's 4% downside in a year.
Yeah.
I wouldn't necessarily invest in the US at this point. I'd invest in FTSE or Japan or probably not China.
I think the risk now with China, if we were to escalate what's happening now, is not just that the TikTok deal is off the table, but all of the shares that are passported over to the United States that we're able to trade through ADRs then become a problem as well. And will we see those?
Why is that, sorry?
So will China encourage stocks to actually be available to...
like the JD.com.
Yes, JD.com, Tencent. Will they even want them to be putting a listing abroad? And are those assets secure?
I haven't actually looked at Alibaba properly. Right, on the daily, you see Baba, got back down to 100. Wow. From 140, Alibaba, I remember everybody, very, very proud to have traded that one because they'd been waiting for so long. And the poor thing always comes back down to 100. Every time it fails at 110, 120 and comes back down.
They're going to have to show a picture of Jack Ma still alive again.
Yeah.
So the big knock here, so even these sort of almost Alibaba now stretches into the media space, but the bigger media and technology and internet players in China, I saw yesterday with the reciprocal tariff escalation, I think Morgan Stanley have put a dampener of 5% of earnings growth on these Chinese stocks.
Right.
So whatever they thought that they were growing at, they're no longer going to have that growth. And so that's where we're seeing it, really falling through into the numbers.
Yeah. Just taking a look, Barclays, that was the trade of the day. Short Barclays on the open up 25%. It was just a little bit too dreamy for everybody, wasn't it? But the rest holding, that's tricky, isn't it? Up 9, 255 in IAG. Rolls-Royce up 8. Yeah, so that's the world that was. What about you guys in the chat? Chart off, thanks, guys. So we've got Steve Davies. Where is the Monkey Man? True, Monkey Man, check in. He's maybe he's away spending his profits of how good a morning he's had. Arthur Fox-Haig. Now, I think this sums up how everybody's feeling, how everybody has felt the last few days, right? His account was at the peak only a week ago. I was the same. Yeah, last Monday, Tuesday. I was up at a 3% on the year, 4% on the year in my Tasty account. My IG was healthy, and then boom. Truffed on Monday. Truffed Monday morning.
That would have been this week.
Up 40% from the lows, but still dented. Yeah, same. That pretty much summarizes everybody, right? People at home, if you feel that, if you're starting to question your ability as a trader from the last week, do not, right? I know hedge fund managers that have been doing this for 20 years that have been smashed to pieces. A couple of them losing their jobs, right? That's how bad they've been in the last week. Do not feel bad about any performance. As we say, there's always the same rules. Keep it small, right? You can have a lot of positions as long as there's nothing that is going to blow you up. No grenades. And this has been an incredible week of turbulence, that, you know, there's no, it's not a black swan, it's an orange swan, an orange swan.
Yeah, and I was listening to Matt Arbour talking about how many black swans he now encounters, and it's no longer an event. We need a new name.
Yeah, it's so yeah, you know, don't be hard on yourself. If you have survived, as some of the guys are chatting about, if you survived this week, then you really you're a star, and give yourself a pat on the back. Right, with that, Martin Harris, thank you very much.
Rich McDonald,
Fantastic,
thank you.
as always. Interested to hear more. You be able to join us next week, or are you off on holiday?
Off on holiday.
Boo. Where are you off to?
Oh, now
Maldives.
traveling around the UK.
All right, nice.
Yeah, there you go.
A staycation.
Staycation, yeah. But I'm going to see a few sites and do some local travel.
Great. Right, if you see this man walking down the street in your local town, give him a wave.
Excellent.
Good stuff. Right, Jamie Goldstein coming up after the break, and we've got the US Open futures. We're looking down 1.25% last time I checked. We'll see you shortly.
Warm in here.
It is warm in here, isn't it? Welcome back, ladies and gentlemen. Jamie Goldstein joining us.
Thanks for having me back.
What a week.
It's been a mad few days.
Have you been in London over the past
I
week?
was in Spain actually. I was playing paddle.
Oh, very jealous.
Your favourite new game.
Well, it will be. I'm not good enough at this moment in time.
It's a good leveler actually. So I play a lot of tennis, but so you can't just pick it up and just play with anybody. But paddle you can, and everyone can mix in.
You get the sons involved, the wife?
Yeah, we all played. Kami and the boys. We all played together.
Fantastic. Oh, that's an early shout out to them, isn't it?
Yeah, exactly. So, and it was good fun.
So give for people that haven't been introduced to you before, give us a little bit of background about yourself and then how we met.
Thank you. Well, a background mainly in property. Property. I was fortunate enough to start at a good time in the early 2000s.
You're not that old, are you?
Yeah. Don't look it. Don't look it. But just turned 37. Yeah.
Like me.
Yeah. So I started in the early 2000s. It's only in hindsight you can look back and go, you know what, we had a bit of a good run there before obviously it all blew up with the credit crunch.
Yeah.
But it was a good introduction to commercial property. I focused mainly on probably leveraged commercial purchases with planning angles.
Okay.
Or more good asset management potential.
And is that sort of factory buildings or retail outlets or?
It was a mix actually. So the first thing we bought was a former Owen and Owen department store in Liverpool actually, which was so big it was eventually over the years split into two. Tesco on one side, and the other side it was a retailer on the ground floor in the basement and some what was vacant upper parts because it was an old shopping centre, and the retailer just used the ground floor in the basement.
Right.
So that was a good opportunity there because you had a tenant there that was paying empty rates on a huge building upstairs that they weren't using.
Yeah.
And it was it was a good opportunity to re-gear that lease, free up some upper parts through planning, and over the following years it was we exited on essentially a lower yield and therefore a higher price.
Because as yield comes lower,
correct. Correct. And I think during that period we were fortunate enough to see good yield compression, and I think a lot of people in property did very well, A, off the back of good asset management, but B, also just off the back of yield compression. We bought a family portfolio of good dry vanilla assets, I remember, probably mid 2005.
Right.
For about 6.5%, and then there was about 8 different assets which we eventually sold individually for 5.5%. It was never the intention; it was to work over time. But 1%, 1.5% yield compression
is huge.
Is huge in terms of the upside. So.
Oh, right. We are open on the old session. Shall we take a quick look, Jamie, and then come back? Because we then interested to hear about the transition into the world of hotels.
Yeah.
But what are we seeing on the downside, first of all?
Wow. Well, I think last night, what was NASDAQ? Did it finish up 11% or something like that? And
one of the biggest days ever.
One of the biggest days ever. So I think we're not surprised, are we, to see some of these moves coming down?
Yeah, a little bit.
A little bit of froth coming off the top, maybe.
Which all makes sense, doesn't it? So Palantir down 4. Any of those stick out to you?
No, not really. I think everything's gone up so much yesterday. I think it's a very difficult trading environment. And I think you called it very well. I think on Monday morning I was sick in bed actually. While I was in Spain, we got a dose of food poisoning, and I woke up Monday morning to listen to your very sincere reach out, call out, to people to say, look, this is tough, and hang in there. And so when we see moves like this up and down now, which are not normal, is tricky.
You can take a 2%, can't you? After
you can take
an
a
up
2%.
20.
Correct. Yeah.
I was scared on Sunday night.
I was too, and I think you said you had a terrible night's sleep, did you not?
Oh, yeah.
Likewise.
2 hours, I reckon. Got to sleep at 1:30. Well, I kind of felt around 1:30 that we weren't going to be down 10. Mm-hmm. At midnight, I thought this could be in 1987.
Yeah, and I think that was a huge concern for everybody, I think, at that time, wasn't it?
Yeah, and that's before bond market started.
Correct. And which was really Tuesday's story, was it not?
Yeah.
So yeah, Sunday night as well. And I think when markets opened on Monday, as you said, there was a lot of panic selling. And I think, historically, I traded CFDs, and now I trade spread betting. But when you're trading essentially a leveraged product, I see myself as being pretty conservative, as people know as well.
As we both do, right?
And so I always make sure I've got enough equity there that I haven't got to have any sleepless nights.
Yeah.
But when things come off considerably, you suddenly look at your equity coming off a little bit, and you suddenly think, oh my God, what happens if we have another 2 or 3 days of this? So.
That's that natural feeling. I'm just scrolling through there so people can see what we're talking. Everything's down about 2, isn't it?
Yeah.
2 or 3s.
Yeah, there's nothing dramatic, I don't think, in there. And I think it's, if you were up 11 yesterday and down 2 or 3 today, it's not really a story there, I don't think, at the moment. Even though on a normal day you say this looks awful.
Yeah, true, isn't it? Yeah, this is just welcome to to 26, 27 vol.
Yeah.
Okay, good stuff. That's we can take that off now because everything's basically down 1 to 2. And well, let's go through a quick look at the UK, catch up with that, and then we'll get back to our chat.
Yeah, Barclays has come off. What was it? 25% up, wasn't it? So that's come off a lot. Nice to see JD Sports up.
That's right.
And I think they were the only ones with a good day yesterday, weren't they, as well?
Yeah, a reassuring trading statement yesterday.
Yeah.
It wasn't great, but it was reassuring. What I didn't realise, 40% of sales now come from the US.
Yeah, they did a big acquisition, didn't they?
Yeah.
So I think that added to it.
Boosted their sales big time, yeah. Everything that was up 9 is now down. Everything that was up 9 is now up 8.
Yeah.
Things that were up 7 are up 6. That's just the way. Tesco now down 6 though. Ooh, that one not loving that update this morning.
They had an announcement. I actually missed that, but I think they were saying, their future projections. I think
for next year.
Have come up a bit.
That kind of the price war. Basically, ASDA is screwing them all over. Coming with this price war.
But I think in these markets, and I look at myself and I go, I'm pretty conservative. It does make you. Need to look at the notional value of your portfolio. Even if you've got a spread betting account, what is it that I've committed to?
Yeah,
and can I sleep at night without having to worry about it? I mean, if you think about it, we've both got ISAs, right? They go up and down. I'm not gonna have a sleepless night about it.
No, don't even look at it.
Don't even look at it. And actually, I say I wouldn't tell Pete this, but he might be watching. But I think the danger for me moving an ISA to IG, even though all of the advantages of cash, etc., is you start tinkering with it, right? Whereas on my ISA, you leave it, you lock it away, I don't even think about it. I almost don't want access to it 24/7.
Lock it away.
Lock it away, yeah.
Yeah.
Save me from my own,
yeah. Well, the own temptation, because when I see a perfectly good stock get impacted the way that it has from a guy that can just tweet an answer and lies about not being about to do it, because the agreement was clearly made on Sunday that they were going to save the market, then the temptation is to just go. I mean, I must admit, even yesterday, I bought Glaxo. I had 6,000 left in my ISA allocation, and that was everything else was in the market. And I thought, right, even 6,000, I'm putting that into GSK.
Well, it's good. And actually, I was sitting with cash in my ISA as well, and I should have been brave enough to go in. But having said that, I don't think this is the end to all of this story, is it?
Interesting.
We'll see.
We just literally, as you were probably coming up from reception, we were just crunching the earnings numbers for next year.
Yeah.
And, you're looking, if you want to take worst case scenario and put it on, an average multiple, you're probably looking about 4,800.
Okay.
Which is where we got down to.
Yeah.
If you're looking at a believable example and a P ratio of where we've been, 5,100.
Okay. And where are we now?
5.4 or
Okay.
5,360.
I see. And of course, it also depends on the discount rate you're using on that, you know.
Yeah, well, yeah, that's the other thing. What is there 3 cuts this year? Is there 4 cuts this year?
Yeah.
So sorry. So let's go back.
Okay, so sorry, I was getting into detail about an old deal that we did but that was my start into commercial property with asset management potential. And as I said, I think you know, if you get lucky and yields move in your favour, it's an advantage as well. And fortunately, I wasn't caught with any commercial assets during
Financial
the
crisis.
Financial crisis. And mainly that was because I think when it got to 2006, 2007, it was very hard to buy anything at sensible values.
Okay.
Because almost all of the upside was priced into the selling price or my purchase price. And so that was hard. So it was hard to buy anything. And sometimes I think, who was it? I think it was Isa was saying yesterday when I was listening, you know, sometimes it's similar with property as it is with markets.
Yeah, absolutely.
You know, decision not to buy is a decision.
Yeah.
So sometimes sitting out the market is a good thing. Didn't get caught there. And I was very fortunate to be introduced to...
well, on that, Jamie.
Yeah.
How do you stop yourself? Right, because it's 06, 07. The world is absolutely going gangbusters, right? We all felt the mining stocks mining companies were buying each other. You know, we had low rates. Just I remember we were we're at a music festival in about 2 hours south of Dublin.
Okay.
Electric Picnic. And we were staying in Dublin for the night on the Sunday night after the festival. And a friend of my friend said, the traffic's going to be a nightmare to drive back up to Dublin because everybody from the festival is going to be on the same road. Shall we get the helicopter in? So he phoned for his dad's helicopter to fly from Dublin to land at the festival, pick us up, 25 minutes up to Dublin, where that was us. And that's the sort of bull market thing. I should have known on that very trip.
Yeah, I mean, we had a similar trip, I think early 2007. A chap from Guernsey sent a private plane over to me and 2 other guys I was working with. And we were looking at data center business.
Right.
And said, come and look at a site in Guernsey. I'll send my private plane over. So we took a private plane. I think it was from Luton. I think, and that was quite good fun. But as you said, suddenly you think to yourself, hold on a minute. There's too much money circulating on very, you know, data centers was very early stage then. But
what year was this? Sorry,
2007.
Wow.
Yeah.
Wow.
Yeah.
Okay.
But you're right. Everything was getting a little bit frothy there.
Yeah.
And
through financial crisis, and you were introduced.
I was introduced. In fact, how I got into Z was I actually didn't have any exposure to any assets in the UK during the crisis, but we did have exposure to a site that we bought in Sofia, right opposite the airport. It was a beautiful big site, which we eventually got planning for mixed-use hotel and office scheme. Right opposite. It's like having something opposite Heathrow Terminal 5. You think fantastic. And I remember it was with a group of other in an emerging country, and it was with a group of other investors. And I remember, you know, sitting around the table, and one of the investors going, you know, it's like having something opposite Heathrow. How wrong can we be? And it turned out the answer was very wrong about a year later. Yeah, it got killed. I mean, the whole thing was so underwater. We had to kind of give the keys back. But along the way, I met one of the investors at the table there. I got friendly with, and we worked closely together. And he said to me, you know, we've been approached by a hotelier who's got this great idea. This was probably 2010, 2011. And that's how Z Hotels came about.
Right, in 2011.
2011, yeah.
Yeah.
In fact, you know, Bev, who had this idea behind the concept, came up with that in 2010. And by the time we actually found the right site and opened, it was November 2011, opened the first hotel in Soho.
Brilliant.
And I think, yeah.
And how the business now is how many hotels?
It's 14 hotels, just about to open the 15th hotel on the south side of Leicester Square. So it's a very good site.
Nice.
And almost 2,000 bedrooms across the group. So yeah, fantastic business. And I think I've said to you before, it's a different. I mean, you've stayed in one, right? But for those who don't know, it's what we would call affordable, compact luxury. It's a
Nice.
a very well-formed small bedroom, ideal for 1 to 2 nights in prime central locations.
Yeah. And modern.
And modern.
That's the great thing. Why would I want to go to the centre of a wonderful city and spend time in a hotel room?
This is it.
Don't give me a Hilton. Don't give me. I'm there to sleep, and that's about it.
Yeah, and I think that's the clever thing about the business model. A typical hotel bedroom might be 240, 250 square foot. We're taking half the size and actually creating a space which is perfect for that 1 night, 2 night stay. But you can do it at an affordable price, right? Because you can get 2 rooms into something that's traditionally one side.
And so cleverly designed as well.
Yeah, well, we do it by pushing a bed up against a wall. Traditionally, to get hotel rating, you've got to be able to access the bed from 3 sides. You've got to actually have a meter around the left, right, and the foot of the bed. That's traditional way of getting a star rating. So once you put it up against the wall, you can't get your typical, 3-star, 4-star, 5-star rating that goes out the door. Yeah. So then, how does it get rated? It gets rated by things like Booking.com and customer experiences that way.
Right. Yeah. You don't care.
You don't really care. Is it? What is it?
Different.
Yeah, the world's different. Correct. Yeah.
Fantastic. Right. Let's jump onto the chat there. Steve Davies, I see the request there is very timely because producer Phil started the Discord chat yesterday. So he's just doing some testing, but I would imagine, let's hear from producer Phil. When do we expect to let people into the Discord room, sir? Monday morning, the Discord chat for all of you to have a discussion between yourselves outside the hours of the show will be available. So very excited to have that. And no Monkey Man. After a couple of whiskies at night, Monkey Man, you just watch yourself. And you, Jamie.
Okay. I'll behave.
So right. We'll get that to you on Monday. Now, what? Run us through your portfolio at the moment and what you've done in the past week.
Well, I think I think I said before, I probably got slightly complacent in terms of taking on new positions and not expecting the shocks that we've seen Thursday, Friday, and Monday. And so even though there was sufficient headroom, I did on Monday morning. I was one of those people Monday morning that said, hold on, I'm going to cut some of these positions.
Yeah.
And I think, I don't know, I've got some positions which I would say are more long-term holds. I would say more investments, and some positions that you trade. I trade the range within gilts. Fortunately, I've been staying out of gilts for a while, actually.
Do you know what? I haven't even looked.
If you look at what's happened to gilts the last couple of days, yesterday was a horror show. Today, I think they came back a little bit.
Long gilt?
Long gilt, yeah.
Right, let's take a look at long gilt.
I think they probably followed Treasury yields higher, haven't they?
All right, there we go. Yeah, so that was Monday, 94 trading and got down as much as to 90 yesterday.
I mean, it's a huge swing.
I mean, that's Liz Truss kind of stuff, isn't it?
Liz Truss kind of stuff, exactly. And I think it's mad when somebody, Trump can just play chicken with the world and look at the consequences for people. And I'm sure people over the last few days have made big fortunes and lost big fortunes. But, this is a man-made issue.
Man-made issue.
Yeah.
And you can see what he's trying to do.
I can see what he's trying to do. I agree. But it's everything at once with everybody. It's a bit mad.
So that 90 days makes a lot of sense, takes so much pressure off. And it really, it's just China now, isn't it?
It's just China, but I don't think the 10% has gone away globally, has it? Is it still the 10% for everybody, or
I think 10% can be absorbed.
it can be absorbed?
Yeah.
So now the play is, as you say, it's this US-China thing, and we'll see how that plays out.
Yeah.
But the markets seem to have said, actually, even though that's a major problem, it's not as major problem as it could have been with everybody. I mean, what was Vietnam was 46, I can't remember now, but when you got that chart up,
something, I think, yeah.
It was just mad, just mad.
Right, there's an update on the futures. Yeah, NASDAQ giving back 2 of 12. So net only up 10% in 24 hours. German DAX, up 5.9 there. So it was, as my friend Derek Banks said this morning, Del Boy of Credit Suisse fame, buy the dip, sell the rip.
Well, yeah, it's a good point. I actually sold the DAX last night at 21,600 as more of a hedge in terms of some of the equity positions. So
Yeah. I've got a one down here, which is, let's see how that's paying off at the moment. So this was, well, when's the 11th? Is that tomorrow? Yeah, Friday. Long the 5,200 call. Oops, I didn't mean to open that. Long the 52, short, double the size of the 53.20. So in an ideal world for me, the market will close at 53.20 on Friday for that trade. So just a little bit more down to go, another 40 points. And I can relax into a game of paddle at the weekend.
How was the trading for you over the last few days then?
Oof. How do I describe it? Chart off, thanks guys. So if I go back to Thursday, I was a little bit lazy on Thursday.
Yeah.
I wasn't fast enough to react to what my core rule is. When volatility goes up through 25, I get everything off. And I ignored it. I ignored a core rule of discipline of mine. Yeah. So I was pissed off with myself about that. Yeah. Because then Friday at 11 a.m. when China retaliated, I did not expect us to go from 5,380 to 5,080.
Unbelievable. Yeah.
And I was sitting there at 8:55 p.m. on Friday night trying to work out what the hedge was. And I sold like £5 a point.
Right.
Ruined my weekend.
Yeah.
Watched it all weekend. Sunday morning woke up and the NASDAQ was looking unch. And I should have put a hedge on then because we hadn't had anything out.
Yeah.
And then, just pure fear at 11:30 that night. And so Monday morning I had to come in, jiggle things around, get more equity into my trading account, move money from Tasty to IG, which is ridiculous. I mean, I'm blooming work for the company and I'm running around outside.
Yeah. So you're trying to do this at the same time?
Well, that was the funny thing, actually. Doing the show on Monday morning, I'm sure you realised I hadn't had much sleep, all you viewers at home. Trying. We finished a segment in here and I ran out to Elliot. It was after Matt Arbour, and I rolled down one of my short put positions.
Okay.
Ran back in during the break, back onto the show. So it was a real, and that's what you have to do on mornings like that, right? Doesn't matter if you're on the floor of Credit Suisse or you're at Millennium or you're sitting on your bed in Spain.
Sick bed.
In the sick bed. Yeah. Everybody had that panic over about a 48-hour period of like, if I get stopped out, if I how do you hedge?
Yeah.
Do I use my ISA? I had a lot of new kind of investors, those young guys that came in during COVID, saying, "Oh, do we sell?"
Yeah.
Right? Is this the time to sell? When the market's at 4,900, you've kind of missed your chance to sell.
Yes. Yeah, it's true. And I think we were all expecting, at least I was expecting, something to happen over the weekend. Mm-hmm. an announcement over the weekend because of what had happened Thursday, Friday in the markets. And it turned out, Trump didn't really care about what was happening in equity markets. And there was a narrative, presumably, to be able to say, actually, what we were on, what was S&P, 34 times multiple. You look at historic averages. There was a narrative to say, I don't care. But when treasuries got hit and, the bond market blew up a little bit,
Yeah.
I think that's when they said, hold on a minute.
Yeah. Step back from
Yeah. The abyss.
So we got out of it.
We got out of it,
Or
but
have we?
Or have we? This is it. This is it.
Well, but you've now got your opportunity. The main problem in markets is when you do not have the chance to do anything. If people mess up now, it's your own fault.
Yes, because you've got time. It's true. All of those impacts were so quick, weren't they? So sudden, and you couldn't react. You're right. Now we have a chance to look at it, reevaluate, put on sensible positions, make sure we understand our
Reduce risk.
Reduce our risk, understand the notional value, and that's it.
Yeah. Jamie, what's next then? Any trips in store?
No trips in store for the moment. Getting my head down here and cracking on. I've got my youngest has got GCSEs, so I'm there as a little support guide over the next few weeks. It's going to be a scary household over the next few weeks with all the panic up to GCSEs. So yeah.
And so it's Easter holidays and then straight into exams.
Easter holidays and straight. I think he's got actually a mock the day he goes back, just before he goes back to school, I think. But,
do you fancy taking some GCSEs yourself?
No, I wouldn't want to do that. Would you? I was last year of O-level. That shows how old I am. Yeah, last year, and I wouldn't want to go back to those days. Would you?
The thought of doing my even driving license now is just a horrific thought.
Scary.
Yeah. It keeps me below the speed limit because I don't want any more points on my license.
But it's almost impossible these days to have no points, isn't it? It's 20 miles an hour in so many zones now, and it's mad.
Yeah. Magic, wonderful. Thank you for coming in.
Pleasure.
I wish we could go for a coffee now, but of course Angeline's enjoying with her feet up somewhere in the sunshine. We look forward to seeing you after Easter.
Thanks very much for having me.
Join us in 3 minutes. We've got Aaron Bright coming in, and Aaron and I are going to have a duel about what's going to happen next in markets. Join us then. Trade expectations, Aaron Bright in the house. How are you, sir?
Very well. How are you, Rich? It's been a while since we've
Martin
done a
Harris has
session
thrown you
together.
under the bus. He told us where you were last night in the pub, checking your phone on tariff updates.
Yeah, of course. I had to see how much my losses were going to fall by, or surprisingly how much recovery was being made.
So take us through it. How's the last week been for you?
Well, certainly a touch busier than usual. I think going into Monday, we were all expecting somewhat of a Black Monday, and obviously that came to fruition.
Yeah.
And then it was just a case of what the response was going to be from different administrations, from China and from obviously the US. And then we obviously got this huge update yesterday. Well, the first headline I actually saw was China's tariffs were 125%. 125%, and I was thinking, well, why is the market rallying? And then I saw the 90-day pause, and I was like, okay, this makes perfect sense now. But the moves we were seeing yesterday, I think the last time the Nasdaq made those sort of moves, I was at nursery, so we're going back a while.
What was that? 6 years ago?
2 years ago, Rich.
And so, you are the master of geopolitics, my friend. So take us through what. Will there be back channel discussions going on at the moment with China? What do you think is the real conversation? Forget what Trump said, forget what Xi's saying in the press. What's really going on?
Well, I think what you've been seeing in the treasury market is particularly interesting I mean, it's obviously not wholeheartedly geopolitics related, but actually when you go under the surface, it is a bit, because we know China's one of the biggest holders of US debt. And I don't think there's a huge surprise that we've seen yields spike around 70 basis points in the past couple of months. And obviously China have been hit bad by the tariffs. So I think there's an element of that going on, a little bit of tit for tat. Look, China obviously one of the biggest trading partners of many nations, and there was a really interesting heat map which showed sort of the each country's biggest trade partner since I think 2002. It used to be the United States, and then now China's taken over, basically dominates the whole of Africa, the whole of South America, and Trump is obviously keen to sort of reduce their sort of power in terms of global trade. So I think it's going to be quite interesting. China, they're obviously going to want to hit back. They're going to want to, stay cemented in this space, whether it's chips, whether it's just general exports. So a really interesting space where she is going to try and flex his biceps. But I think he has lost the art of the deal here to Donald Trump.
Do you think?
I think there's elements of that, yeah.
In what way, though? In what ways Xi lost? By
Well,
standing up to a bully?
Well, I think he's allegedly wants to now come to the table and make a deal with Trump. So Trump is
Hang on,
obviously
who
very
said that? Trump.
Well, this is just what I'm reading, that there's rumors going around. I mean, it's in Xi's interest to continue to export to various markets, and obviously the US as well. So it depends whether Xi folds or not. So
No, but I mean, look, if we are hearing rumors that Xi's going to make a deal or is interested in making a deal, then the market's 5,700.
yeah.
So
of
where's
course.
that coming from then?
What do you mean by that?
Well, where's the talk of Xi wants to make a deal? You can't listen to Trump, right? That's complete shit. So is there anything substantial out there that Xi's looking to make a deal?
It's just rumors at present. Obviously, I think he doesn't want to appear weak. That's look, in this sort of situation, it is a battle of egos as well as a battle of sort of economic trade. So I think Trump doesn't want to. His whole sort of raison d'etre is to appear very strong and to sort of do this sort of bull in a china shop approach.
Look, it's the only way that he could get out of the mess that he had created for himself yesterday. Either he had to sack Navarro or Lutnick, or he had to keep the tariffs with China, right? That's the only way that he could not look like he had folded, like he had blinked, like we all know he did, right? The bond market beat Trump. He had to keep that with China. Now, he's going to eke his way out of that as well, right? That's not President Xi that's getting on his knees and coming to Trump for a deal. Besant said very openly yesterday on Fox News that it's America that wants a deal with China, that it's China that doesn't want a deal?
Well, I think it's an interesting scenario, and we're just going to have to see how it plays out. Look, I think it's in everyone's interests. I mean, Trump's wants. It's very clear that Trump wants America to be at the forefront of manufacturing and domestic industry again. Obviously, the American consumer, American electorate, American public, and many businesses want cheap supply chains. So yeah, it's there's a lot of sort of interests and egos here to manage, but it's a really exciting space, and I'm watching it very closely, and the volatility we're getting from it is quite exciting and hairy for sure.
Best guess on the outcome and the timeline?
Well, I think I wouldn't be surprised if it does rattle on for a couple of months or so, in terms of all different countries coming to the table. If you know, because even if the 90-day elapses, you know, you've still got trade partners with the US who are going to be paying upwards of 10-20% tariffs. And I'm sure that, you know, I think it was 70 countries came to the table willing to negotiate with the US.
You're still believing what you're hearing from Aaron. Do not believe a word he says. He's lying. We now know for a fact he lies, because Bessent told everybody this was agreed on Sunday. On Sunday, when they saw where the market opened, Trump and Bessent had a meeting and agreed that they were going to give a 90-day pause. Right? So we know he lies. We know the whole administration lies, especially that press secretary that is the most full of shit I've ever heard anybody in my life. So therefore, you know, don't be believing anything Trump says.
Well, I mean, it's other media are saying this as well. So I don't know. I think it's just a case of watching this space, seeing how it develops. But I think it's in everyone's interests for various countries. You know, look, if I was president of, say, Japan or South Korea, and I had you know, large amounts of trade with the US, would I want to make a deal? Absolutely.
But that's why they're in the White House, right? Those deals are getting made. Vietnam's deal was made before this was even announced. Vietnam said that they would go to 0% tariffs on last Tuesday. So if we take for granted that Japan deal is done, Vietnam deal is done, why has he got a problem with China, and how long does that continue for?
Well, it's very obvious the reason, in my opinion. He's got a problem with Chinese hegemony, economic and geopolitical hegemony. Very, very clear. He said, you know, if you take the word of Trump himself, he says that China's just ripping everyone off, and he doesn't like their activity in the South China Sea. He doesn't like, you know, their sort of involvement with Russia and Iran as well, allegedly. So he wants to sort of suppress Chinese dominance, I would say. And that's where this is coming from.
So then the whole thing was really about China.
Oh, for sure, definitely. China was I would say at the forefront of this, and you saw that in 2018 as well. 2018, tail end of 2018, you saw this.
Right. So how does he do that then? How does he quash the risk in the South China Sea? How does he stop them stealing IP? Right, which was Shark Tank guy's argument that you know, that China just steals IP from everybody. DeepSeek is the probably best example.
Yeah.
You know, how do you do that? Do you do that through tariffs, or do you do that through a deal?
Well, it makes it hard for them. If you put tariffs on someone, it's immediately making it difficult for them to carry out their activity. So, like, if someone was putting tariffs on me and disrupting all my you know, my economic activity, my ability to export, of course I'd be really frustrated, and I'd want to sort of come to a solution with this. So I think from that perspective, it makes a lot of sense with what he's doing. South China Sea is a little bit more complicated, but we know that Trump, I mean, even if you take what he's been saying about Iran, that he's not afraid to take action on their nuclear sites over the past few days. I wouldn't be surprised if you sort of, if China was getting vocal, or there was more military exercises regarding Taiwan. I wouldn't be surprised if you saw sort of more US troops shifted to South Korea, where they've got bases, because we know what Trump's
so you
like.
think
He likes
could
to
go
flex his
military?
muscles. Well, I'm not sure if he'll go military without reason to do so, without sort of an invasion of Poland or a Archduke Franz Ferdinand assassination moment. But I mean, he'll flex his biceps. That's what he does. He'll say what will scare China, and he'll move troops. I think that's just what what he does. Really, it's
Okay,
different
so
to other presidents.
what about a war game exercise in the South China Sea this weekend, for example? Does that have markets really start to worry on Monday? Because it came across very much yesterday. It was this, right, we call off tariffs for the rest of the world, market up 12%, S&P up 9%. Okay, maybe the tech companies don't care because they're not in China.
Yeah.
But the S&P up 9% with an increased risk against China. Do you think that was wrong?
I mean, you're certainly seeing a lot of irrationality at the moment. I think in markets, you definitely. I mean, the perfectly efficient market hypothesis, I think, has been disproven these past couple of days, given the sort of moves that we've had. But look, yeah, it's an interesting space, and I think it's just everything is very on edge at the moment. We were coming into the year with very frothy valuations, which is why you saw such a sharp sell-off with the tariffs, with all the concerns about, potential recession risks, all in the mix, and then it's almost like a straw on the camel's back. This tariff thing with everything going on, but obviously it is still a huge thing, the tariffs. So, yeah, interesting, and there's a lot to see this year for sure. We certainly haven't seen the end of this.
But if you do a tariff-free deal with Vietnam, for example, then what's to stop everybody moving production to Vietnam? So he does hurt China, but in a way that the rest of the world doesn't really care, right?
Well, I think he'll be happy with that, to be honest, because I mean, if you look at your sort of Nike trainers or whatnot, a lot of them will stay. Well, yeah, I mean, I'm sure there's Vietnam and Cambodia.
I haven't even looked where they're made. Let's check that.
Let's have a look.
In the meantime, Andrew McKelvey's saying, Rich, sorry, what world leader does not lie? You've got a fair point. Made in Indonesia.
Oh, I didn't expect that.
Made in Indonesia. So who were also hit with big tariffs. But yeah, maybe is it more the clothes in Vietnam? I'm not sure. Yeah, so where do we put it then? Where do we put it on the degree of lying? On the degree of will anybody in the White House have been buying stocks in the past 48 hours?
It is quite interesting that Trump did tweet saying, now's a great buying opportunity, DJT. And then the market goes up 9.5%. So, yeah.
Like, the SEC must just be looking at this.
Yes. I mean, it is a bit of a concern when that happens and someone's got that amount of power and you see market moves based on, tweets, essentially. But we saw it the other day with that Walter Bloomberg account with the intraday rally. I mean, the biggest move intraday since the flash crash.
Well, but essentially that was somebody leaked it by mistake, or somebody in the White House, leaked it. Because that proves the decision was made on Sunday night.
Does, yeah. It does. Or they were debating it and no one was 100% sure, and then someone got caught wind of it. I'd love to be a fly on the wall in the White House to see what's being discussed.
Yeah.
It'd be very interesting to sit around these tables.
And the degree of what they actually know what's going on, and how unbelievably arrogant and pompous they are.
Yeah. Very interesting, for sure. And alternatively, what the Chinese are thinking regarding this as well, Chinese government.
Yeah. Now, Aaron, let's come a little bit closer to home. In the UK and Europe, how should we be thinking, right? We're not trading on 21 times earnings.
No.
We're a little bit more enclosed, protected, if you will. We're not fighting with China. What happens next closer to home?
Well, it depends how you see the British economy going. If you're looking at probably UK equities, I mean, I'd say that our recent budgets and autumn statements and spring statements haven't been the most growth positive. They've been very tax heavy. But as you've correctly said, we're at sort of an earnings multiple which is nowhere near the US is, even post this volatility. We're not anywhere near it. So from a valuations perspective, from sort of price to forward earnings, trailing earnings, UK is looking very attractive, and it was at the beginning of the year, an area where investors could have sort of got away a little bit from the US exceptionalism point of view by adding to sort of Europe and British equities.
Chart up, please, guys. That's the FTSE 250. So we can see March the kind of 30th we're looking at, really, aren't we? We were close to 20,000. We bottomed on Monday at 17,500. So what's that, 25? Yeah, it's about 12% drop we had. Let's bring it in a little bit closer. 12% drop, and we're currently sitting at 18,666. Uh-oh. So that's the FTSE 250, Aaron. Yeah, what's your view on that?
Well, we don't have any exposure directly to the FTSE 250, just given the fact that the economics of the UK wasn't the most inviting, and this sort of area of the market does well, during periods of economic growth, interest rate cuts, but during periods of volatility, economic concern, the small caps tend to get hammered. So it's an area we've avoided, particularly the UK side of things. We allocate much more towards the FTSE and large caps, and have done so given the volatility we've seen. Obviously, post Trump and the victory, US small caps were really, really positive, and we benefited from those additions. But we've seen really negative volatility. Real big sell-off in the Russell 2000 over the past month.
There's a growing consensus that the macro world has changed. If you look at Ray Dalio's comments this morning, let's see if actually I can find that in the FT while I do. But take us through how this changes the macro picture on that wider scale, that sort of medium term.
In terms of the tariffs?
The whole fight, the deglobalization, the new power, that really changed on a philosophical term, economical. Where does it leave us?
Well, I think the biggest concern is I always try and empathize with different economic actors when I want to understand how they're going to be feeling during these sort of situations. So if I was a CEO of a steel company, I'd be immediately thinking, well, I've now got my earnings are being compressed. I've now got to pay these tariffs potentially.
Yeah.
I've now got to onshore production. So immediately I'm thinking, okay, well, business might not look as good. We might have to cut staff. All these factors are going to be happening for thousands, if not more, businesses around the world. So immediately that's a bit of a concern. And I think you're going to get that widespread if people are going to be facing increased costs. If this era of free trade begins to dwindle, it's a concern because we're so interdependent on other nations for cheap goods over the past sort of 20, 30 years. It's been really a hallmark of globalization. And now if we move away from that era, it adds a little bit of concern.
Take away from the steel industry, right? Let's not segment one industry that people can just leave and retrain and get a job in making an Apple phone in Detroit or Texas, where they're such specialist employees of screwing little screws into iPhones. What's the wider implication for consumer, for hospitality, for travel and leisure, for manufacturing?
Well, it all links, Rich. I mean, if you face increased costs in one area and it affects the whole economy, then you're going to get decreased consumption. If you're
but it's a
paying
one-off
more
cost, though. It's not a tariff every year of an additional 10%.
No, but if companies are laying people off, if you're generally seeing sort of a contraction, businesses not expanding as much because their margins have been suppressed, it's gonna have this sort of multiplier effect that you sort of learn about in economics, where in this case it's sort of a negative multiplier. If you're laid off, then you're not gonna have as much discretionary income to spend on holidays. And
But
that's why you've seen the
job
volatility in the
market's
airlines.
too tight anyway. We know it is 4.1% unemployment rate, and he's actively cutting immigration. So
Well, at
you've
the
got a
moment,
tight job market.
it's a lagging indicator. So, you know, we'll have to see
So where
how
do you
these
see unemployment in 6 months?
I mean, I need my crystal ball for that, Rich. But
That's your job, isn't it?
well, yeah, it's true. Look, I mean, it depends. It depends on the extent of the tariffs and inflation, really, and if they're inflationary, if businesses are facing increased costs, absolutely, unemployment will rise because they're thinking about shareholder value. They're thinking about how can we keep margins strong, how can we keep earnings strong, and how can we grow our earnings? Well, if you're facing increased costs, you might have to make cuts across your business. So that's why, you know, unemployment is concerned, and that's why we're seeing central banks, investment banks, sorry, raising recession risks. I mean, they are going up and down a little bit like a seesaw, you know, 40 to 60% the whole time. But yeah, absolutely, I would say that there's a significant chance of recession in the United States, which, I mean, by and large affects the whole world.
Right, chart up. So we see the figures here from the last economic projections, right? You saw a cut in GDP from 2.1 to 1.7. Too high, too low? 1.7% for 2025.
I think that's probably quite a realistic figure. If you see these sort of 90-day tariffs kick in, and the Chinese ones, if they start affecting supply chains, absolutely, you're going to see ripple effects throughout the economy. Obviously, Trump's long-term vision is to onshore a lot of this production and to embody and empower the American consumer, but it's going to come with pain, as he has said.
Unemployment 4.4.
Yeah, that sounds something that's quite realistic, I would say.
So then how many rate cuts do you get then? So we've got federal fund rates expectation 3.9.
Well, there's a concern because let's say we've got increased costs, but increase in unemployment and fall in economic activity. So let's say we've got a form of essentially cost push inflation, but increased unemployment, and we're enter a stagflationary environment. What do you do? Very difficult scenario. You can't really cut rates if you've got high inflation, and that's going to be the concern.
But if you're talking about a slowing growth, where's inflation coming from apart from the technical aspect, right? You've got consumer under strain, you've got people losing jobs. They're not going out spending, so you don't have the demand effect.
No, that's true. So it is offset to an extent, and that's obviously going to be the dynamic of where we see rate cuts going. And it depends if we see, I know obviously we've seen oil shoot down at the moment, but if we see any concerns over if there's any sort of geopolitical issues, which, the tensions are there in the Middle East, Southeast Asia, then we might see oil spike up in price again, which to an extent might get offset by the fall in demand, but it's all about the magnitudes of these moves and which is more significant.
So, all right, well, there's a trade there, isn't there? Because you're saying that the Fed can cut rates as long as the oil price doesn't go up.
Well, as long as inflation doesn't creep up, yes, and the economy is slowing. But oil is obviously a driver of inflation, the oil price.
Yeah, so year on year, we're down 20% in WTI, right?
Mm-hmm.
So that's a significant downwards pressure on inflation.
Yeah, absolutely.
So as long as you've got that tailwind, then you can cut rates.
Well, yeah, it just depends on the whole basket, I would say.
In fact, does the 20% lower oil price wipe out any tariff?
Well, I mean, for some businesses it will affect them, but for others, I think, it might not. Some may not be heavily reliant on, energy and that kind of production costs, which you get from sort of natural resources, but they may have huge amounts of raw materials or other imports from China or from Europe or from Asia, which are going to be, 20 to 100% higher than they were before.
Right, so as long as you're hedged in oil, then you get 3 interest rate cuts, then unemployment, 4.4, we can live with that. It sounds like the market's all right to me. Sounds like the market can stomach all of this without, we talked earlier with Martin you've got earnings expectations. They were 260, 268. What do you think EPS is for S&P 500 this year, right now? Because 268 is the expectation.
I wouldn't be surprised if it's a little bit lower than that. It's always difficult to give figures and not be shot down. But look, I'm not going to be. I wouldn't be surprised if you know these tariffs. And remember, the S&P 500 obviously is not just tech. It's got 493 other companies which do other things, which some of whom have very complex supply chains and very, very dependent on international trade. And if these costs come up, their earnings per share is going to fall. And at the moment, we've only got that 90-day. That's all we can work with at the moment. We've got the 90-day pause. We've got 125% tariff on China.
So 2024 earnings were 246. So is 2025 higher or lower than that?
I think if the sort of tariff and everything sort of comes to fruition as expected, 90 days elapse, no deals. China,
no, there is deal. There are definitely deals in the 90 days. He's said that already. That's why Japan's in the White House, right? So imagine a 10% tariff globally apart from China. What are S&P earnings?
Well, I think they'll falter a little bit because we're getting.
So you think lower than 2024?
Yeah, there's definitely a potential of that. It's difficult to say without seeing how things are unfolding because so much is changing. So it's hard to give a sort of a full-on estimate depending on.
As we are, I'm giving you a scenario. Oil price 62, right? So down 20% year on year. Unemployment 4.4, little bit of increase in unemployment. Tariff rate 10% globally. China comes down to 60%. You get 3 rate cuts between now and December.
Well, the rate cut adds a different scenario. Obviously, that reduces debt costs for businesses and it should bring down treasury yields. So then that's a completely different ballgame now. You've got rate cuts. It will boost equities and then that will obviously help businesses be able to, finance things, bring down treasury yields, and that's obviously beneficial for companies' earnings. It's an expansionary monetary policy by definition. It should help the economy.
So that you see rates, you see earnings being higher in that respect.
If the rate cuts come to fruition, yeah, of course. But the
bonds are telling you can trade that. It's a 2-year yield of 3.84. So that's telling you there's 2 rate cuts there in the treasury market.
But then if you look at the long end, you've got yields really, really, flying upwards.
Yeah, but the long end doesn't tell you what the Fed's doing in the next 6 months.
No, it doesn't. But it does show you inflation concerns about long-term inflation, I'd say.
Yeah, but that's. So you think they isn't that saying that the market thinks it's a mistake for them to cut rates, but they will cut rates because the 2 years telling you they'll cut rates?
A little bit, yeah. There's definitely a little bit of that, but they're obviously and what all the banks have been saying and what all the strategists have been saying, and I agree with this, is they're concerned about increased costs, and then that obviously increased costs, inflation, if it's affecting supply chains.
Yeah, but they've had a massive cut in their energy bill.
I know, but that's just one part of it. So there's obviously so many different moving parts. And yeah, as I said, obviously if geopolitics changes, the oil price can go back up again.
I think you're very low on earnings if you think earnings are going down year on year. I mean, then you're a bear, right? Then you must want to get out of your aggressive portfolio that's long equities.
Well, I wouldn't say I'm an out-and-out bear. I'm definitely a bit more bearish than Martin, but there's just a lot going on at the moment. There's a lot to digest, and we're slowly unraveling that, and I think we're positioning the portfolios accordingly. I mean, we've got elements of risk in them, but I think there is opportunities where we can add more risk, but then also diversify across different equity sleeves as well.
Yes,
equity sleeves which aren't as high valued as the States.
And explain that.
Well, as I said at the beginning, of this call, that US was coming to the year, what, 23 times earnings?
So you've moved out of US.
We haven't, but we still have good positions there. But we have looked at other areas. So we added to sort of global small caps last year, which is basically across a broad spectrum of small caps. Got exposure to basically all different equity markets. So we're not just I mean, if you compare us to the MSCI World, the All Countries World Index, we're relatively underweight because that's like 75% US equity exposure. We're something like 62, 63. So there is a slight underweight, I'd say.
Nice.
But it's a damned if you do, damned if you don't with the US. If you miss it, you're obviously going to be gutted. But then,
well, not when it was 6,200. It wasn't. Then it was damn move my money, as we discussed in December.
Exactly.
What about we look Japan, Europe?
Well, I mean, from a valuation perspective, interesting areas. Germany's quite interesting with the amount of stimulus, government policy around that area. But I think there's just a lot of volatility, which is likely to affect all equity markets if this continues, both on the upside and downside.
Brilliant, Aaron. Thank you very much. Enjoy the rest of your day. What are you up to this afternoon?
Thank you. Just working, unraveling what's going on in the markets.
Yeah, and waiting for CPI. People, don't forget that CPI. Watch that. See if Aaron is right, if inflation is going to come lower and help out those potential rate cuts. Be careful this afternoon. After a 9% move, who knows what could happen. Tune in tomorrow to find out what did. Thank you very much for joining us today. Thank you, Aaron Bright, for your expertise as always. And yeah, best luck. We'll see you tomorrow.
How about that ride in? It's Wednesday, April 9th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, as we are here to take you through the most remarkable day in my lifetime in the stock market. S&P 500 up by 9.3% right now. NASDAQ up a paltry 11.1%. Your Russell 2000 up 8.39% in today's session. The bond vigilantes have won, ladies and gentlemen. Liquidation overnight gets Trump to tap out. On Futures Power Hour today, we were privy to that announcement. If you joined the 1 p.m. Eastern show, you saw us react in real time to the news that the tariffs would be lowered against the 70-plus countries that have come to the table for negotiations. There's a little caveat there.
And did not retaliate. The ones that were nice and obedient servants of the king.
Those that kept their fealty to the empire will be rewarded. In turn, we see that Chinese tariffs will be increased to 125%, which sets up a pretty funny bit of math, which we're going to have to look into here shortly, about what the U.S.'s effective tariff rate will be moving forward. And here's a hint. It's higher than it was then this morning. Nevertheless, it's the relief that the market needs. If we're not cutting off our trading partners, they will continue to buy our debt. We had an excellent 10-year auction today, the second best bid to cover ratio in history. Minutes later, we get the announcement from President Trump himself. Bond yields get off of their highs, which was a scary night overnight in Asia.
My God.
I was trying to get out of my positions and it was not getting filled. And I'm here sweating. I told Ilya, it's like 1 o'clock in the morning. I'm almost throwing up.
Oh yes, there were many frantic texts as both of us were looking at our bond positions, going, oh no, wait 2%, 3% on what? And it certainly got really hairy going into Europe. I was pleased that my exposure was in TLT, so all I could do was watch in despair and couldn't actually do anything, because if I had the freedom of managing my positions, Lord knows the damage I would have done.
Well, the damage wasn't too terrible for me. Today was a relaxing day.
Yes, this is a whole lot better than it looked at the bottom of that wick.
Yeah, ZB only felt 23 ticks, but really The story now is of what Trump said himself. Jamie Dimon told him he was going too far, as he just said at the White House. Bonds were going too far. Markets were getting a little yippy, in his exact words. We found real proof, ladies and gentlemen, that the put is not in the stock market, it's in the bond market. The Trump put is in TLT, not in SPY. Do we have a level to trade around now for the rest of the year, ladies and gentlemen, in ZB, right around 112? Those lows that you have at this.
What a low.
What a low. They will not let yields move back where they were at the start of the year. That is a very important observation here. But you know what? That's not just the day-to-day. We have to talk about the basis trade, what Japanese fund may have blown up overnight. We also have to talk about the move in gold and silver. Gold up 4%. Thankfully, silver getting some of it back. Dylan, you're the laureate around here. You're the one who has the best market memory. You've lived through so many crises and have come out on the other side better, stronger, harder, better, faster, stronger, as they might say. What do you make of what you've seen this week? Did Trump just show his cards with the bond market comments today?
I mean, I have two thoughts. One, I had a conversation with Rich and the guys at IG in London this morning, and we had this exact conversation, which is where is the discipline for the Liz Truss that is now called Donald Trump, the sort of idiot politician making unilateral economic policy, and the obvious answer was the bond market. So the two couple thoughts. First, obviously, the bond market is the most powerful thing on earth, more than any president, more than any trade alliance, more than any currency. The U.S. bond market is the most powerful lever of power in the material world. And I'm really wondering if Trump has become so predictable as to be the 2025 equivalent of the 2024 oil trade whenever there was saber rattling in Iran. And basically, every time you get a rally like this, he's going to start to wind up tariffs again. Market's going to sell off. When it sells off, he's going to then back out. Basically, it's like an idiot child with a real economic nuclear bomb who doesn't understand and thinks it's fun to scare everybody. It's like somebody with a machine gun in a nursery school swinging the gun around and thinks it's funny, who's drunk. And so it's kind of a sad state of affairs for the world, to say the least. But it does make me wonder if this has actually become somewhat predictable, and that he's always going to threaten something to get he feeds on attention. He doesn't have there is nothing else. And so he'll do whatever the next thing is to get him the most attention. And so he needs to make threats to accumulate attention. And then he needs to relieve the threats to make it to continue to accrue attention. The difference between this and past crises is in the past, financial markets would adjust their levels based on some real external event, whether it's the global pandemic, a financial crisis, too much leverage is almost always, one, right? No one has ever seen a situation where the global financial markets are in a full panic, crisis, crash, rally, whatever you want to call this.
Sure.
Because of the idiocy of one political leader. It's a sad day for the world. Today only makes it worse, honestly.
Well, that actually is I think the key takeaway to all of this is, I think, exactly what Dylan said just now. Why didn't the markets freak out about the tariffs in November? Because the tariffs themselves are not the reason they freaked out. When we got into the beginning of this year, it's the implementation of the tariffs being erratic and the uncertainty therein And not just the tariffs, but also the Doge thing, the immigration thing. The rollout of everything has appeared so chaotic that you started to see it in consumer confidence and in business confidence. That's what the markets didn't like. Tariffs, no tariffs, whatever. All of these things were perfectly digestible depending on how they would appear as a concept when the election occurred.
Sure.
It's when business confidence fell away and consumer confidence fell away that the market said, okay, this is a cyclical risk now. This is a risk to growth. And then when Liberation Day comes, notice, when it's initially the confusion that it's 10% across the board, the markets rally.
Oh, I was feeling good.
They rally because they have certainty.
Right.
This is not about anything other than uncertainty around implementation and what that does as a dampener on economic activity. It's only when the foam board with the many rates comes out and you start to go, wait a second, these are going to be bilateral negotiations until the end of time. We're never going to get any certainty. You're going to negotiate these things from Bahrain to Botswana one by one? What? This is going to take forever. How could you ever have any certainty? You notice then that the thing that happened today actually adds more uncertainty because it shows that the thing can swing this way, it can swing that way. When it's time for the season finale, today was implementation day, there is a cliffhanger of some kind at this point, almost guaranteed, it seems. And so the show goes on, but do the markets have any more certainty? No, less. And
I mean, other than that's what I'm sort of speculating, Ilya, is whether the certainty is that he will always make the play for attention and he will never go through with anything that he says.
Guys, he's a real estate guy. The rates went too high. He's a real estate guy. If the whole plan is to refinance the debt and lower rates, you can't have a 4-year yield goes from 3.85 to 4.5% in 36 hours because of mishandled policy, right?
No, definitely not.
He tapped out.
But also look at the upshot. Look at where the S&P stopped. Just as a benchmark.
Hold on.
Does this change the recession that's probably coming?
Yes.
No.
Yes.
I don't think it does.
Yes.
And I think what you're about to tell us about net tariff rates is why it doesn't change it.
That is, yeah. Do technicals matter in this market? There was an astute observer the other day who pointed out that how can you follow technicals in this market? Fair point, right? This is uncharted territory. Technical analysis itself is predicated on the idea that past price action can help in some degree be informative about what the future may hold. After all, it's price. Price is a reflection of human psychology. Human psychology has not changed in any significant matter in 2,000 years. We're still running around with the same meat bag machines in our head that make us make the same decisions and feel the same emotions as the people in the Roman Empire did. So past performance actually in some way may be indicative of how the market may unfold moving forward. In this environment, do we have many corollaries here? No. So what do you do, right? Technical analysis does not necessarily hold. But where the market decides to stop today, perhaps in Ilya's parlance, let's just drag up the underside of the recent S&P 500 range here. That's fascinating. Because it's right around Liberation Day where things really start to fall apart. You can see similar type of price action in the NASDAQ. And there's some funny thing about this math. So let's set the stage. Donald Trump today, Truth Socials, and I quote, for those that weren't here, by the way, on Futures Power Hour, you witnessed this in real time. For those that haven't seen this yet, quote, based on the lack of respect that China has shown to the world's markets, I am hereby raising the tariff charge to China by the United States of America to 125% effective immediately. At some point, Hopefully in the near future, China will realize that the days of ripping off the USA and other countries is no longer sustainable or acceptable. Conversely, and based on the fact that more than 75 countries have called representatives of the United States, including the Department of Commerce, Treasury, and the USTR, to negotiate a solution on the subjects being discussed relative to trade barriers, tariffs, currency manipulation. There we have it. The trade barriers, currency manipulation, non-monetary tariffs, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States. I have authorized a 90-day pause and substantially lowered reciprocal tariff during this period of 10%, also effective immediately. Thank you for your attention to this matter, as if we haven't been paying attention to anything else. Okay, so let's work through some math here, folks. Very plainly, we take all of the tariff rates that were presented to us last Wednesday when he held up that ridiculous whiteboard of doom in the Rose Garden. The U.S. effective tariff rate would have risen to 21%. Now, this is variable here because we don't know if this 10% tariff rate applies to Canada, as in it's now 10. Is it not applying to them, so it's still the 25? Is it a combination of 25 and 10, so it's 35? We don't know that yet. The White House has been reached out to by several officials. White House officials have been reached out to by several reporters. Those reporters have not received a response yet, so keep that in mind. But assuming that these are the numbers in Trump's Truth Social post, with China going up to a 125% effective tariff rate, the effective tariff rate that the U.S. economy has right now is no longer 21% from when we started the day. It's now 25%. Tariffs are higher now after all of this is said and done. After the 12% rally that we see in the NASDAQ today, the effective tariff rate for the United States is higher now than before Trump's announcement at 1:18 p.m. Eastern Time. So, Ilya, this is the only question. This is the only question in the world that matters here right now. Sell the rip or buy the dip.
Sell the rip. Sell the rip. So I was, as you know, selling put spreads at the start of this week because in my mind, there was a strange thing in the price action on Monday.
You did good,
where the news didn't get better, but stocks stopped falling. And so I looked at that price action and said, let's take a shot. Why aren't they falling? They should be. Or at the very least, nothing about the reason why they were falling has changed. But they've stopped. Today, we get this reprieve. Obviously, the markets storm higher. I've booked out of this. I'm done. I'm closed out. And it's because this does not change the fundamentals of what any of this means for the economy, which is why the markets decided to be afraid of it in February in the first place. Again, the markets could care less about this drama. They care about what it means for economic activity. And this uncertainty is prolonged. These tariff rates, as you've just eloquently illustrated, are net higher. This is a bigger hit to growth, not a smaller one. Break-even inflation rates are falling to tell you that whatever uplift to inflation the Fed was so afraid of, if you read the Fed minutes today, that's going to be overwhelmed because demand is going to fall out of the bottom.
Mm-hmm.
The markets are looking through the one-off adjustment to price from the tariffs and saying, right, yes, one-time adjustment. And then the next thing that happens is the economic impact of your one-time adjustment, which is a deep and horrible recession that so overwhelms your one-time price adjustment that inflation expectations are sinking.
Okay, but let me give a counterpoint to that, perhaps.
Sure.
Dylan, at 125% rate for China, we're in the territory where trade effectively is dead between the two countries. We could go up to a 200% tariff level right now.
I mean, 500. These are funny numbers. Whereas now.
Yeah, right. Like I see the feed here, which I really appreciate the people participating, right? There's no TDS in this comment, I promise. But there is a certain point where when you rise to a certain level, you're killing trade, right? So at 125%, for example, we saw numbers that were released today by the WTO. At these tariff rates, 80% of trade between the US and China would stop because it just becomes too expensive to do. And so at that point, you go to 130, 150, 200. The impact is already there. It's already priced into a certain degree. And it's such a ridiculously high number that the market says to itself, there is no way that this is actually going to happen. It's so outlandish. You're really going to take the world's two largest economies. You're not going to see some bigger escalation between the world's two largest economies. There's no precedent for that. I don't know, Dylan. China is the country that made
War of 1812, I guess. I don't know.
Well, I would point to World War I, but this is a country that endured the Great Leap Forward and decided to stick with the CCP. Yeah. It seems like the tolerance for what the CCP wants to accomplish historically is very high. No.
The tolerance on that side seems probably greater than the tolerance on this side.
Well, regardless, though, it feels like a funny number, right, Dylan? Like, this is so astronomically high that it clearly has to be a ploy to bring them to the negotiating table.
But obviously he's going to bring that number. If you think that he's not going to back off of that number,
right?
There's a bridge to be sold in New York, right? Come on. This is a joke. This whole thing is a joke.
And that what makes this such a double-edged sword right now for traders, because you obviously have this rip-roaring rally. The tariffs levels are being lowered and eliminated for most trading partners, which is a good thing. And quite frankly,
more than that, the president is proving it's all bark and no bite.
That is part of it, that maybe he's not going to follow through if equity markets and bond markets
punish him. It's not so much what he announced, it's so much that he announced anything indicating that he actually has zero credibility.
And the tariff hit is actually bigger.
No, but this whole tariff discussion is a carnival sideshow that's never going to happen.
I think that, Ilya, we have to weigh these two factors here, right? If you're placing your next trade, do you care more about now that the tariff rate is actually in reality higher than it was before we started today's session? Or do you care about the fact that because the barriers against most other people that we care about, our allies, our strategic geopolitical partners, all of the people who are going to need to fill in the gaps of the supply chains that we have out of China, if we were to do some global reshoring among allies, maybe the factories don't come back to the U.S., but we drop tariff rates between, say, the U.S. and all of South America. And so you can't probabilistically say this is going to be a fade. This is definitely a buy still.
You don't have to make the decision between those two options. It's option 3, which is what Dylan said.
Which is?
Nobody knows because the whole thing is still erratic. It still changes on a dime. And businesses are ultimately still not going to have the confidence to put together a 5-year industrial build-out plan on the basis of this, because this policy is fickle and changes too quickly for anybody to output capital and take it at face value. And so the hit to growth remains.
The hit to growth, and I would say the hit to growth remains, as well as the marginal disinterest in doing business with the United States.
Yes. Because nobody can still look like, if you're a purchasing manager anywhere in the known universe now, are you going to take this and say, okay, my supply chains with the US now look like this. I can project out a year, 2 years, 3 years, what my inventory levels should be, what demand is going to look like, what employment's going to look like. Are you any wiser for having heard this today? No. So sentiment in markets has improved, of course, because the markets were getting hit in the head with a tire iron, and now the hitting has stopped. Well, that's great, but your head is still bleeding.
And you still have somebody in the room with a tire iron who'll swing it randomly at any time.
That's right. That's right.
Yeah, but didn't we just learn today that if Bill Ackman cries enough on Twitter, like, he'll just if Jamie Dimon, Bill Ackman, if Scott Bessent we talked about this yesterday. Scott Bessent flew down to Florida apparently on Sunday.
Oh no, the interview that Bessent did with CNBC yesterday.
He's beclowned himself. Bessent's really embarrassed himself throughout all this.
I'm saying the one he did yesterday in particular. If you watch it, the level of apologetic, I'm sorry, everyone, I didn't realize it would come to this. That was the undertone to the whole affair, was just so transparent that it did look like the administration would eventually blink and at least some cooler heads would prevail. Frankly, watching that Bessent interview made me happier buying risk yesterday because it looked like the facade was melting.
We are halfway between, effectively at the underside of the range here. If you're talking about SPY, where we bounce from starting in mid-March, March 12th, prior to the breakdown from Liberation Day, you still have IVRs that are in their mid-50s here. The lows are probably in for the foreseeable future. Whether or not that means we're going back to the highs is a completely different question. But while there's still volatility to harvest, there's a good, at least I think there's a decent opportunity for traders to examine directionally neutral strategies, short iron condors. I prefer short iron condors to short strangles personally because of the defined risk nature of them. But this feels like that kind of environment that we should be playing in. I don't think we're out of the woods by any stretch of the imagination with equities, right? It's probably going to be choppy here moving forward. A disciplined long-term dollar cost averaging, right? Earlier this week, Ilya, if you have a very different mindset in your trading portfolio versus your long-term investing portfolio. Long-term investing is just accumulation. You buy stuff, you put it in there, you stash it away. You don't plan on touching it. Your 401k, your Roth IRA, those type of things. This is a great environment to get down in. Monday, we talked about what we'd go on for discounts, right? The Metas of the world, the Googles of the world. You were looking at IXUS. We were talking about, Dylan, the second generation AI names. IXUS is up 7.39% today. Meta here is up 14.8% today. The AI super cycle isn't over, Mr. Radigan. We still got another fight left in us. I think we can trade around the lows now. Trump showed us his cards. The Trump put is real. It's not in SPY.
But would you get? But would you sell the rally as much as you wait to buy a dip?
I'm much more confident selling against the lows in TLT than I am in SPY. But on dips around this trade situation moving forward, even if the market digests the effective tariff rates and says, hold on a second, tomorrow we get a little bit of a pullback. I think we have enough of a low where our wedding crashers trading mindset, right? Selling put spreads against the low. I don't necessarily think you're going to rally. I just think that you're not going to fall. That's still the right way to do this. I'm not convinced on the bull side from here after 12%, right? Directionally neutral from here, maybe buy the dip on a pullback, but if you get a further rip from here, it's an opportunity to sell. I don't think you need to be directionally married yet, even if you came into today like this. But the bond story is really the most significant part of all this. Last night, Ilya, it was melting down. I'm in futures, and I'm out far enough where there's not a great ton of liquidity in ZB futures at 1 o'clock in the morning Eastern time, and this thing is eating dirt. But we do stage a turnaround. It seems overnight that we have a Japanese fund or two that blows up regarding the basis trade. Basis trade is a fun trade. If you're really looking to make money, free money, when it's easy out there, if you're an institutional investor, you work at a hedge fund, you go into the market, you buy the cash futures, the cash bond, and you also then sell the futures contract, the synthetic futures contract, right? Why are you doing this? You're trying to capture the differential. Less trade costs, less transaction costs. They have to converge. So if you hold the cash bond position until expiration day and you're short the futures, they will converge at a point and you're guaranteed to make the difference. It's called the basis trade. You lever that up 50, 100, 200 times, you're starting to print money in good markets. 2 times in history has this broken down before. Long-term capital management, 1998, during 2020, March of 2020 during COVID. There was just no liquidity in the system. It's drying up. It looked like it was drying up overnight last night. The basis trade was blowing out for people. You see 10-year, 20-year swap rates in the interbank market moving to some of the most extreme levels on a one-day basis in history. And it spills over with these Japanese funds that are ultimately being liquidated overseas. We get through our trading hours here. ZB is back up to 115 and 12. Casually where we were at the end of March, like nothing's happened. Same thing for ZN. This is now only a 0.62% loss on the session, but hey, we're holding up against former support here. I feel as compelled as ever, given where Trump just tapped out. If you are a bond trader in these markets, if you're trading TLT, ZN, ZB, the swing lows that we just established today are the Trump administration's pain point. They want to bring down yields. They want to bring down housing costs in the midst of a tariff war. You're going to have to bring down mortgage rates, but they want to bring down the cost of financing a car. They want to bring down revolving credit rates, like for consumer credit cards. You're going to need lower rates across the curve. And the second we see bonds cross that threshold of moving out where they were prior to the announcements, bond market rings the bell. Trump himself said it today. The bond market, he's paying attention to the bond market. And he says the bond market is now beautiful again in typical Trump parlance. That's your line in the sand. Today's lows in ZN and ZB, you can I will be trading around them like they are as good as gold. They're going to be rock walls for me. If we're below them, obviously none of this matters. But that to me is our defined level of risk. That's the tap out point. The Trump put is in TLT, not SPY, this administration. Ilya.
I'm long. I mean,
Long the bond?
I'm long TLT verticals. I have quite a bit of duration in them still. And they're probably the closest following to ZB. So if we take a look at ZB here, even the current contract, it was obviously an absolutely insane night. The wick on it looks just crazy. But I think, first of all, there's clearly a pain point for the administration here, to Chris's point. And secondly, even just more near term, if what that was an unwind of the basis trade and a bunch of other things, inherent in it is why that happens in the first place. Why do people freak out? Why do these trades suddenly start to unwind? And Chris, this is the image I was sharing with you earlier. When we look at that insane bond rally or a yield rally, bond sell-off on Monday this week, what we find is that inflation expectations are not what's doing it. It is a massive surge in term premium. That is to say, if you want duration in this market, you got to pay for it. Because nobody has any idea what's going on. There is a ton of uncertainty. If you're going to be borrowing money with any kind of time on it, people want to get paid through the nose for that extra time because of how unhinged and uncertain the environment is. And that then ripples out into failing basis trades and closing hedge funds and all this kind of thing. People panic because the fog is so dense. And the way you see how dense the fog is by looking at the term premium and watching it surge. So then two things. Number one, the term premium unclenches here if the put is really in the bond market, as I think Chris suggests, and as I would agree. Moreover, we have CPI tomorrow, and we can see from the minutes that the Fed just published that they were so concerned about inflation, and we can see that the market is telling them now since the beginning of April, which is obviously after they had the meeting, The net impact of the tariffs on inflation is negative because the growth hit outweighs the price adjustment. Fed knows this now. It can see it. They have their answer. If the FOMC minutes tee up the question, the price action since has given the answer. The Fed no longer has a barrier to cutting rates. Their barrier has fallen away in practice. They told you what it was, and you can now look and say, is it still there like it was when they were talking? Nope, it's gone. So you get a soft CPI number, and the expectation is we're going to get the first 3% core reading since 2021. You get even a little softer. And, I mean, the Fed is already priced in for a cut in May.
We want a lot softer because if the tariffs do what they're going to do, they're still going to lead to inflation jumping up, right? I mean, that's the whole thing
but the
about
markets
this.
have looked through it already.
Today feels.
I mean, at least that's what the break-even rates are telling us.
Well, yeah. I mean, that's the funny thing. If you look at different measures of inflation expectations, Dylan, there's a very clear cutoff. That cutoff seems to be like December 2026. The market seems to be convinced that no matter what happens between now and December 2026, we're going into a different regime thereafter. Yeah, the market's up 12% today, and the S&P's up 9.7, and I've read the chat. I'm reading it here. I'm entertained, so I appreciate everyone participating. But people saying that the market's now, 12% today, what do you have to say about tariffs now? We were at 6,200. We were at 6,200 a few weeks ago. What do you hear yourself? We still erased like $8 trillion worth of equity market value. Yields are higher than where they were.
And permanently obliterated credibility.
We've damaged our relationships with our trading partners all over the world, right? We didn't get any respect back out of this. There's a great analogy here. If we're all playing a game of poker and I lose a hand, and in response to that hand that I lost, I take my hand and I swipe it across the table and wipe everyone's chips off. And everyone calms me down and is like, okay, all right, I'm sorry, everyone. I'm sorry I did that. That was unbecoming of me. People are going to treat me differently sitting at that table with them. They're going to have in the back of their mind, okay, when Chris has a losing hand, he's going to start to get angry and he's going to try to flip the table again. They will treat me differently thereafter. They'll also read my emotions differently because they'll see, oh, he's getting angry. He has a bad hand. I better take my chips and protect them because I know what comes next.
And maybe I don't invite him to the next game over at Ilya's house.
That's right.
Because he's a fruit bird.
I mean, that's the other side of this here. Like right now, a lot of countries are relying on us and we rely on them for various things. It's a nice symbiotic relationship. We're taking the mafia enforcer approach, which is one way to do it. Not my cup of tea, but maybe it's accomplishing something. I don't think, though, people can turn to today's action and say, see, it all worked out. It hasn't worked out yet.
Definitely not.
It hasn't worked out yet. We have a relief valve today, for sure. But the effective tariff rate now at the end of today is higher than when it started this morning at 12:01 a.m. when all of the tariffs went into effect. And so if we're talking now, listen, the goods components manufacturers, all those small manufacturers, all the layoffs that were coming, that is not going to happen immediately. Those that are relying on China have a real problem on their hands now. But because we're not cornering out Thailand, Malaysia, India, Vietnam, right? Because we're not closing off the entirety of the supply chain, there is an opportunity now to find new sources. The fallout is not going to be as severe as it otherwise may have been. I'm not ringing the alarm bells I was ringing this morning or over the past week on Twitter anymore because we're just not in that world. But we're also not out of the woods. Fed's not going to cut in this environment. If the Treasury market starts functioning appropriately again, we don't see this basis trade blowout rankling things in overnight hours. Credit markets aren't blowing up. The Fed's not going to come in with support. This modeling today, we can simply take the CPI basket. We look at the imported goods component of that basket. We take all the countries out of that basket and we tinker with the new tariff rates one by one. China 125, Canada, Mexico 25, this country 10, that country 10, yada, yada, yada. Shove it all back in, compress it, where's inflation going to rise to over the next year, ceteris paribus, all else held equal, you're now looking at a 1.8% year-over-year rise in inflation from where we are right now. That brings headline CPI to 4.4% at a minimum. So we're not out of the woods right now. If you made money in the long side, again, this is a speed dating market. We're not looking to marry. We're not looking to marry anyone here. Ilya, you speed dated this week.
Oh, very much so.
And look, you're feeling like a king. Because you're taking your
feeling much better than I did when I dipped my toe in. I'll tell you that much.
It is still bizarre world that you were pressing the longs harder and faster before I was today. Doesn't make a lot of sense to me. So Dylan, what's the next move here, though? I mean, like, we know that there are economic realities on the ground that still exist. The second Great Depression isn't staring us down, but we still have rocky seas ahead. What do you do with stocks?
Boy, I think the safest assumption is that the China tariffs also won't happen. So because the same way Iranian retaliation in Israel is predictably theatrical and not lethal.
Sorry, Trump just said he didn't realize that the tariff pause would have that impact.
Oh, great!
Come on, man.
Great.
That the Trump withdrawal of whatever threats is basically as certain as the non-lethality of an Iranian missile attack. And so the only factors in place are, one, America's run by an erratic and unreliable leader who has absurd tendencies towards extreme statements and takes pleasure from making the whole world bow to his will. All of the growth will slow down and confidence will be reduced as a result of that fact. But also that Amazon, which is probably the most directly related to the China trade, like if Trump is going to shut all trade with China, that would, I would think, would hurt Amazon. I would think that would hurt Apple. There's probably a decent list of 10 companies. Nike in Vietnam, right? I mean, I don't know. Maybe Vietnam was one of the friendly and subservient nations that it was given a stay of execution today. I don't know. But I would buy the names that benefit from when Trump withdraws his China tariff threats. And I would still continue to harbor into the defense of the consumer discretionary, telecom, all that jazz. And it sounds like you want to own the bond.
I mean, I think
it sounds like rates are going to come back in for a minute because now the bond market has established primacy over Donald Trump. And so if the bond market has established primacy over Donald Trump, it does clear a pathway for higher bonds and lower rates, maybe.
And so we're back to regular recession.
Right.
Just regular recession. Not a
regular
meltdown.
Recession caused by American policymaking.
Yes. Yeah, so like we're in a better position than we were this morning. In a sense. We're still in a much worse position than we were a week ago.
Oh, 100%. 100%. We are now going into a regular recession whereby if the bond market has a conniption, there will be a reprieve, but the growth hit will not be countervailed. The certainty
but also
will
the tariffs
not be
won't
had.
happen. Right.
Well, maybe they will, maybe they won't. We're going to keep doing the great and powerful tariff show probably for the next 3 years. And so the markets ultimately will have the recession that they're going to have because there's no certainty and businesses don't spend money if they don't know what they're buying.
Trump says that he didn't realize the market impact here. Understandable. Self-proclaimed smartest man in the world. Bond market's difficult to get. That's why so many of us are figuring it out. But legitimately, I I was very fearful of what would happen to supply chains. Like I know this. I've I shared this with Tony yesterday. He's complaining about people being multiple tariff and COVID experts at the same time. I happen to sit at the nexus of that by virtue of trying to start a manufacturing startup during COVID. So I'm intimately familiar with the import-export laws of this country and what needed to be tailored to actually build the certified masks in order to get them out the door into hospitals. We are away from the worst case scenario of the entire economy facing a sudden stop. That is a huge relief. And if you were shorting the stock market or the bond market for the past week, you can say thank you to yourself for saving the economy. Bond vigilante saved the day. So if you've been making money short SPY, TLT, if you're making short ES or ZB, we have to thank you for turning the ship around.
I know I did my bit.
I'm not joking. I mean that very sincerely. If the market didn't punish Trump for this wouldn't have come to some sort of change of direction today. So from the bottom of my heart, because I've talked to all the small businesses in town who are like, yeah, we have like 3, 4 weeks, 6 weeks of working capital. And like if the tariffs go into effect, we have to shut down. There's no way to source our supplies for the hardware store. Right? That business is going to stay open. Thank you for shorting the heck out of this market and keeping small businesses in America open. And thank you for giving us a defined level to trade around here moving forward, because we know where the tap out point is for the Trump administration now. The Trump put in TLT hereby resides at 85.57. I will be trading around that level. I will be trading around that level for the rest of the year like it's ironclad until it breaks.
I mean, I took the news today to say I know that ZB looks bad right now and TLT does, and I'm a bit upside down on these longs, but I've just been told to stay long. So, okay, I will until I am told otherwise.
Dylan, what's the play now going into tomorrow?
Come on. I mean, the madman play is to get short.
I might do that, just not yet.
But it would be awfully soon to do that, though. Gosh,
Yes.
The madman play is to get short. The prudent man's play is to stand by and watch a minute. And the sort of moderately risk-seeking fellow might buy some bonds. How about that?
Apple has a real problem on its hand here, folks. Apple's up 15.3% today, which is just wonderful. Love that. What's not wonderful about this is that if Apple wants to shift its supply chains immediately, it's probably going to push up the cost of an iPhone to $3,500. Let them eat cake, of course. No one's entitled to iPhones. Sure, okay. This is America. People and their definition of freedom is buying stuff. You want to work so you have excess money so that you can use it however you want. For many people, for the median voter in this country, that's what freedom is. That I can do my job and that I can do whatever the heck I want with the money that I've just earned. I want to go paragliding. I want to go to a theater. I want to go on vacation. I want to buy new power tools for my wood shop. So be it. When inflation's too high and the cost of living goes up too much, people can't buy their crap. Me included. Makes them angry. Apple has a problem coming down the pipeline because we're not going to be able to buy the Apple crap. I have half a mind right now to go out and do I need a new computer? Yeah. Does my wife? Yes. She's at work right now, so she's not listening to this, but should I go buy her a MacBook today? They still have them in stock at the nearby mall. All that's going to change. So there are real supply chain functions that are going through here. Today is a relief rally among relief rallies. I would also remind people that we have seen some very, 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 very vicious bear market rallies over time. Bear market rallies have been fast and furious. We've seen them evolve from all sorts of places and circumstances. biggest bear market rallies of all time in the S&P 500. And I have to pull this up here. There we have it. Biggest bear market rallies of all time. Financial crisis. From November 2008, you get a rally of nearly 25% from the low, right around the Troubled Asset Relief Program.
I have a particular scar from that one. It nearly gave me a heart attack because I was long dollars, and of course that was basically just inverse of the stock market. My God, that one was bad.
.com bubble, summer 2001. You have a 20% rally in the Nasdaq. You got a 20% rally immediately after Black Market, the Black Monday crash in 1987. During the oil shock, you have a 15% rally off the low. During the China slowdown, there was initially a 20% rally before continuing on to new lows. The point is that the stock market is going to find relief valves or can kind of clear the deck of risk and reset the table. And we've reset the table here today. We've cleared out the risk of the worst case scenario being priced in two markets now. It raises the question, as Nick and Mike were talking about today, though, what happens after a rate cut? The Federal Reserve, I'm hard pressed to think it would cut rates given the inflation outlook. But if it is cutting rates due to the inflation outlook, you're talking about rate cuts for recession reasons. And rate cuts for recession reasons aren't good. Since the early 1980s, when the Fed has done these recession rate cuts, the average return of the S&P 500 1 month out is minus 2.2%, 3 months out, minus 14.3%, 6 months out, minus 12.8%, and 12 months out, minus 11.6%. Got to be really careful what we wish for here. Unless you're in gold and silver, because my goodness, I'm going to definitely talk up my book here. The U.S. is an unworthy counterparty. It is an untrustworthy counterparty. It is flippant. It is capricious. If this was not my home country and I was watching this from the outside, I would be dunking on it so hard. This is not serious policy led by serious people. The excuses being trotted out don't make any sense. Bessent told us today he went down to Florida on Sunday and he said that it has nothing to do with the bond market reaction. Trump turns around and tells us that the market was getting too yippy and that the bond market is really beautiful. So Bessent, like Kevin Hassett, has no credibility whatsoever. Peter Navarro, I like when he talks because I think the interactions that him and Elon Musk are having are quite entertaining, right? Like
also, Peter Navarro is consistent.
It's like two of the worst people you know are fighting. I'll watch.
Yeah.
With gold,
I mean, I disagree with 100% of everything Peter Navarro says on economic policy matters, but at least he's consistent.
Yeah, actually, Dylan, speaking of consistency here, I've seen many people in the chat say this too. Let's just go to the heart of the matter here. Intellectual consistency is very important to me. Didn't we just have a whole round of DEI hires in academia get kicked out of their jobs because of plagiarism? Peter Navarro is a guy. Peter Navarro is a guy who plagiarized, made up sources. He writes Ron Vara in all of his books as a source. It's just his own name, an anagram for his own name. Okay, we've known this for years. He's still held in high grace. The guy is a joke. He's a clown. Elon Musk is 100% right here. The fact that he's held up in high regard when there was just all these get rid of all the plagiarists, right, in academia. And Peter Navarro ran as an anti-growth Democrat in San Diego and lost twice. Like, this guy's a serial loser. Why are we taking any ideas from this guy whatsoever? And now,
because he wrote a book. Because he wrote a book that was entitled "Death by China."
How did he get into Trump's orbit, by the way? Oh yeah,
because they Googled for the book because Trump liked the book title on Amazon. He thought it was a cool name,
and that's
so
why
they brought him in because he wrote a book with a cool name. And that's what's going on.
That's why gold's so good throughout all this. Last few days were rough, but we're away from the edge now where people are selling everything nailed to the floor to raise capital. In a world with the U.S. behaving as it's behaving right now as an unreliable counterparty at the federal level, do you feel better allocating your incremental unit of currency as a reserve into US dollars right now, where trade relationships and capital flows can move on a whim? Or do you want to put it into something more stable, a little bit sturdier, something that has legacy, something that you can pass on to your kids? Gold's looking pretty good here.
What? You running a late night coin ad on me here? A little
Couldn't help myself.
insomniac's delight, a little gold coin action at 2 a.m.
Right, yeah. It's like on Comedy Central after the Girls Gone Wild tapes, right? Like it's the remember those commercials in the 2000s?
Pass it on to your children.
Right. Now it's time for the gold coins and various experimental collectibles.
But I mean, I think the headline, regardless, I mean, the Trump headlines are not going to change. He is what he is, and they are what they are. But it was a triumph of the bond market. And
the triumph of the bond market.
That would be the newspaper headline for tomorrow. If I'm running the Wall Street Journal, I run the bond market as a lead, and then the hope is that the bond market is so dominant that it reduces Trump and his merry band of fools to a distraction as opposed to a credible threat to the global economy. Because basically they're now penned in. I know I'm saying this the last minute of the show, but your best case is that the bond market has fenced them in and marginalized them to the fools that they are. And that as a result, the market may normalize. That would be the other sort of side of this whole thing.
God bless the bond vigilantes. With that, overtime is out of time for this Wednesday, April 9th, 2025. We'll be back tomorrow, same time, same place here on Tasty Live, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan, Milan, I've been Chris Vecchio in New York. Thanks for joining us again today. It's been a wild week. We'll catch you later. But stick around. Ilya is back. He's here for Macro Money coming up next on Tasty Live.
See you there, everybody. What a day this was. I'm sure most everyone has seen the headlines at this point, but man, do we have a tariff news update today. Markets rip higher as we get a stay of execution on the worst of the reciprocal tariff plan, or do we? That's where we find ourselves here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We're going to unpack what that was just now in the financial markets and take a look at what it might mean once the speculative dust settles and the spotlight turns back to what this story is really all about, the U.S. economy and what these tariffs might be expected to do and why the markets have been upset about them in the first place. We, of course, are going to get exactly that sort of a check on the environment as we get U.S. inflation data coming at us in less than 24 hours. So let's break this down. We started off this week talking about where the markets landed with last week's blistering sell-off. And we noted, as the week was getting started, that the markets stopped at a very auspicious spot. And that in this spot, you were probably, as the markets refused to break past it on Monday, you might see some kind of a recoiling because it seemed as though the news had not improved, but the market had stopped selling. And indeed, right on cue, this ends up being a place where the markets turn. Let's zoom in here on the active contract for the S&P 500. This is the ES future for June, and this is the daily chart. This was a weekly one right here. So here we can see where we started the week and where we are today. Here we can see where we started the week, and that stalling, that stop in the sell-off that we were just mentioning. And then, of course, today we rush back higher. No, we stop right at the underside of the preceding leg down. So just at the spot where we get Liberation Day. That's this right here. This is where the sell-off really garners steam last week. And here's the preceding leg of the initial decline, where we find a little bit of a reprieve before Liberation Day, when, of course, the tariff plan is unveiled, and the market clearly has a hard time digesting it. So, what to make of all of this? Well, the rally comes as the president comes out and says that reciprocal tariffs, which were supposed to get introduced today into practice with all of their varied rates across many economies, will not, in fact, go forward as such. It will go forward, but only with a baseline 10% tariff rate for all trading partners but China. China, since it has already retaliated to the president's actions, will instead face a 125% tariff, which is an increase, and at this point, these numbers are hovering somewhere in the realm of the mythological. At this point, we might as well say it'll be a 500% tariff, or a tariff rate of a bajillion and one. It looks very much like now the stage is being massaged to some kind of negotiation, and clearly those countries that didn't retaliate, it is being shown see reprieves occur. And so the upshot is that the tariff threat has been watered down some, but more importantly, that the amount of consternation in markets has been enough that there is, in fact, a reaction function from the White House. We've heard all through this decline last week and going into this week that the weakness in the stock market was going to be overlooked, that this was par for the course for implementing this new policy, and that the dust would settle and things would be okay. Today, we see that the level of pain grew too much, and we get a step back that ultimately speculative interest likes very much. And so we get this dramatic rally, and that makes sense. But where does this leave us? Well, the place where this move lands seems very appropriate to start that discussion. Again, we land not with a new high, but with a volatile reversal that nevertheless leaves the breakdown intact. We retest the underside of the preceding range. We fail to make it over. Does that mean we won't make it over necessarily? Well, of course not. But what we still see here is a trend lower, lower lows, lower highs. And then we start to consider the upshot. Why didn't the markets sell off on tariff news in November when they knew that some sort of tariff regime was coming? That was here. Markets were not upset here. Why not? Because it's not the tariffs they're upset about. It is the uncertainty with which fiscal policy, as epitomized by the tariffs, has been put forward. And so it is not until mid-February, late February, when business confidence surveys like the PMIs, consumer confidence surveys like the one from the University of Michigan and the one from the Conference Board start showing that all of this policy uncertainty is starting to end up with lower economic growth expectations, weaker sentiment, and decelerating growth, it is not until then that the markets start to care, which is here. And so it is the uncertainty of execution that really seems to bother investors, not the trajectory of the policy goal as such. And so with that in mind, we look at what today's announcement brought, and it was another U-turn in a policy that looks no more predictable now than it did yesterday. Moreover, what we find is that we still have the same basic architecture of the economy before or after this. Consider, this is the GDP Nowcast from the Atlanta Fed. And again, as we've said a lot here on the show, it's not about the level. It's not about whether the economy shrinks somewhere between 0 and 1% if you discount the impact of gold imports recently, or between 2 and 3% if you don't discount them. That's not really what's important here. These nowcasts take in information sometimes daily, sometimes every several days, depending on when the economic data comes out. We will surely have an update after this incoming batch of data this week, but it's not the absolute levels that matter. Those will change as that data is factored into the model. It is the direction of the data. And we can see here clearly from February, about the middle of February, right here, the data begins to aggressively deteriorate to show not that the tariff policy is negatively impacting things, but that uncertainty about fiscal policy, including tariffs, is putting a dampener on economic activity. And that's why the sell-off kicks off here and not earlier. And with today's announcement, that uncertainty has not been in any way relieved. Consider what happened on Liberation Day itself and this upward wick on the S&P. Why does that happen? Because initially, when the president comes into the Rose Garden and says we're going to have a 10% broad tariff, market actually likes it. It is not until he comes up with the foam board with the multitude disparate rates country by country that things become not to investors' liking. Because if there is a blanket tariff, well, then at least it's forecastable. And that's all that the markets seem to want. A runway and a pathway for businesses to follow whereby uncertainty can unclench, whatever the outcome. But that is not what we have here. What we have is another sort of situation where we seem to be moving the goalposts frequently, and businesses and consumers are going to have a hard time extrapolating forward. And of course, by extension, likewise, the markets. And so once the dust settles on the speculative element of this, we are left with this. An economy that has started to significantly decelerate because of uncertainty. And while policy expectations have meaningfully unclenched as well, as of yesterday, the first rate cut was already on the menu for May. It is now back out to about July to be fully discounted. Moreover, the amount of rate cuts has significantly come down. But if we actually look at the total tally, we can see here yesterday into today, it is barely changed. In fact, it's been barely changed for about a week, where the markets are looking for essentially 5 rate cuts with some room for error to the dovish side between now and the end of next year. What's changed is that yesterday and the day before and toward the end of last week, the market saw many more rate cuts coming in 2025, 4 of them, and maybe between 1 and 2 next year. Whereas now we have 3 coming this year, so 1 less, and 2 with some optionality for a 3rd next year. In other words, all the markets have done as a consequence of this announcement is take 4 rate cuts for this year and 2 for next, 1 and 2, let's say, and moved a cut back by a year and said it's not 4 this year, it's 3, it's not 2 or 3 next year, it's 1 or 2. And so the makeup has ostensibly moved to a somewhat less urgent setting. But the upshot that we need 125 plus basis points, 125 basis points would be 5 cuts, and again, with a little bit of optionality for a 6th. That's what we need, whether you sequence it this way or that. But the total has largely remained unchanged, and most importantly, that total is greater than what the Fed has in mind. The Fed forecasted in December and then reaffirmed at its latest meeting in March from 4.4 on the headline rate down to 3.9 this year, that's 50 basis points, out to 3.4 the following year, that's another 50 basis points. That's 100 basis points between now and the end of next year. The markets are obviously 1 rate hike or 1 rate cut and some change to the dovish side of that. And that has not been altered. It's just now the markets see more cuts later versus sooner. Moreover, when we get the minutes from that March meeting today, amid all of the uncertainty, and amid all of the swings back and forth in stock markets around the president's announcement, what we find is that the mood for policymakers in March mainly was a troubled concern with inflation. We have here growing concern about inflation persistence amid trade policy uncertainty. Almost all participants viewed risks tilted to the upside for inflation and down for employment, with the outlook for real GDP growth weaker than January. And of course, participants linked all of this and said participants observed that the inflationary effects from tariffs could be more persistent than projected. In other words, the inaction we've had from Fed officials around all of this speaks to their concern that the tariffs might be bigger and stickier in their upward in their upward impetus on price than they were anticipating. But of course, the markets have taken it a step further. What those Fed minutes tell us is they tell us what the Fed was concerned about and why they are not cutting rates, or at least signaling that they're ready. But what the markets are saying is that the hit to growth from these tariffs will be so great that their impact will be disinflationary. That is to say, the tariffs will raise consumer prices such that consumption takes a hit, investment takes a hit, growth overall is dragged lower, and the hit to demand is so severe that inflation actually goes down because whatever uplift from the tariffs is more than overwhelmed by the pull that weak demand and recession have going the other way. And so if the Fed minutes establish for us why the Fed isn't cutting as of March 19th, this collapse in break-even rates since early April is telling us the Fed's wall of worry need not be there, because the market is telling them that inflation expectations as a consequence of this are going down and not up. With that, of course, the incoming inflation report becomes absolutely critical. We're expected to see a downtick, 2.6% on the headline figure and 3% on the core. For the headline, that would be the lowest since October. For the core, that'd be the first time we see a 3% at the figure reading there since April 2021. So this is significant disinflation being signaled here. Moreover, if we look at the dynamics and the trends that the Fed likes to watch here, we can see that if we get another downtick, it would mark a third consecutive month after January and February that the trend in annualizing 3-month and 6-month changes in CPI might imply. So we see here the sort of internal dynamics of where inflation is going. What the Fed likes to do is take the 3-month change and annualize it, both for the headline and the core, and kind of get a sense of the dynamics. And what we see here is for 2 months now, the annualized 3-month rate, headline and core, lower. 6-month rate, core, lower. Headline 6-month looks about the same, but certainly not rising. In other words, at the start of this year, we start to see inflation begin to roll over downward, and this would be a third consecutive month of seeing that, even, again, as these break-even rates are telling us the inflation scare is leading to lower inflation expectations as a consequence of the tariffs, not the other way around. So the barriers to the Fed moving from here, 100 basis points, to here, a more dovish setting where the market is pulling them, might well be breaking down. And if we were to get a CPI report that endorses that, we might certainly see evidence as much. Now, of course, what that would imply, as we've seen over the recent months, is that the economic hit is already underway, hence the disinflation. We've seen that it has come mainly over the past several months at the expense of core services, which is where growth has been and what has led to the U.S. economy outperforming as well as it did last year. And so the upshot here may well be that this rally